Welcome to Acera's pre-retirement seminar. In this seminar, I'm going to tell you all the things you might want to know in the 3 years leading up to retirement, or maybe even in the 3 months or 3 weeks leading up to retirement, because you're going to retire soon, which is why you're in this seminar. And since you're going to retire soon, you probably have some questions. Questions like, what do I need to know? What do I need to do, if anything? We're going to answer those questions for you during this presentation. And I've organized the answers into the form of this pre-retirement checklist. So we're going to go through this checklist during the presentation. The first item on the checklist that I'm going to talk about is I'm going to help you understand your membership. So we'll talk about your contributions. We'll talk about we'll look at a retirement timeline, and we'll talk about your tier. I'm also going to help you get an estimate of your retirement benefit. And so we'll talk about, hang on one second. We're going to talk about the retirement formula a little bit. We'll talk about purchasing service credit briefly. I'll tell you how the vacation that you might sell affects your salary component of the formula, and I'll show you our online benefit estimating tool. I'll also help you verify your retirement eligibility, choose your retirement date. I'll take you through the application process to retire. I'll help you understand other benefits that we have, like medical, dental, vision. We'll talk about a little bit about some other life events, and then just briefly about signing up for Acera News. All right, let's go ahead and jump right in and get started. First item on the checklist, understanding your membership. So who is Acera? In one sense, Acera is this acronym, the Alameda County Employees Retirement Association. So that's what the acronym stands for. But really, Acera is made up of a lot of people. So there are about 90 of us that work here at Acera. And what we do at Acera is we provide retirement, disability, and death benefits to our members. And that's all of you. So you are also part of Acera because you're members of Acera. And you're members of Acera because of the position that you work in. So you either work currently or at some point you worked in a full-time retirement eligible position. And that position is for one of the 6 employers that participates in Acera. So that's Alameda County, Alameda Health System, the Superior Courts of California, First 5, the Housing Authority, and Livermore Area Recreation and Parks District. And one more thing about that, you are automatically an Acera member. You automatically became an Acera member because that you worked in that full-time retirement eligible position. So your membership is automatic. Now, as an Acera member, you contribute to the fund. So every time you get paid, you will see a little bit come out of your paycheck, and that's called your employee contribution, and that goes into Acera's fund. And you can verify that on your pay stub. Under the deductions column, you'll see a contribution go into retirement. Additionally, every time you contribute to the fund, your employer is also contributing to the fund on your behalf. And so what do we do with all that money? Well, we invest it all over the world with the goal of earning interest on this money that we're collecting. So these are the 3 sources of income that give us Acera's fund. Okay, so now we have this big pot of money called Acera's fund. What do we do with that money? Well, meanwhile, you are working and you're earning credit toward retirement. So as you work, you earn credit toward retirement. And that can mean a few different things, which I'll talk about in just a minute. And then at some point in the future, you're going to retire from Acera and retire from your job. And at that point, that's when you start collecting that retirement that you've been earning throughout your career. And you're going to collect that every month for the rest of your life. So you're going to receive a retirement allowance every month for the rest of your life on the last business day of the month. You cannot outlive your retirement. That's what for the rest of your life means. I will also use the term lifetime retirement allowance or lifetime benefit during the presentation. So it's a steady monthly payment that you can count on for the rest of your life. And you earned it. So here are some pension milestones. This is kind of a high-level view of some of the different events that you can expect during your membership with Acera. So first of all, we have your date of hire. This is the first day that they told you that you should show up at work if you started out in your full-time retirement eligible position, or if you started out part-time, this is the first day that you worked in your full-time retirement eligible position. Okay, so then for most everyone, 2 weeks goes by, and the first day of your second pay period, that's your date of entry into ACERA. I think the housing authority is the exception to that. I think your date of hire and your date of entry might be the same. And there might be one other group that's true. But for most people, there's this 2-week period where you're waiting for the first day of your second pay period, and that is your first day of ACERA membership. And that's the day that you start earning credit toward retirement. Then 5 years goes by. Once you have 5 years of what we call service credit, so it's like 5 years of full-time work, then you're considered vested in the retirement system. And vested just means guaranteed. So when you're vested in the retirement system, you're guaranteed the vested benefits, or you're guaranteed the guaranteed benefits, basically. That happens at 5 years. Then there's a next point in the future where you become eligible to retire. And it's going to be based on how long you've worked, and it's going to be based on your age, and some combination of those gets you to retirement eligibility. And I'll talk in detail about those during the presentation. So once you're eligible to retire, then you can actually retire. So this could be your first day of retirement. You could retire on the day that you're eligible, or you could keep working and keep earning more credit toward retire sometime later. That's up to you. So your retirement date is a date that you choose in the future. Now, there are a couple of milestones after this. So once you retire, you start collecting that lifetime retirement allowance that you've earned, and you're going to collect that all the way up until the day you die. And that is when your retirement payments stop. But depending on which retirement option you selected at the time of retirement, if you named a beneficiary for a continuance, which is a continuing payment after your death every month, then they could continue to get a benefit for the rest of their life every month. And we'll talk about that during the presentation. Okay. So this is the point where I want to introduce you to the worksheet that I created. So there's this worksheet. It's called the retirement planning worksheet. And in fact, I can show you where to get that worksheet. So let me just do a new share here. So you go to, drag this over. You're going to go to News and Events, Retirement Planning Seminars. And then you just scroll down, go to Pre-Retirement Webinar, and it's right here, Retirement Planning Worksheet. So this is a PDF. If you download it, it is fillable, or you could just print it out and do it by hand. And this is kind of your takeaway. This is maybe a summary. You can think of it as a summary of all the stuff that you're going to learn here today. So you can fill it out as we go along. I did update it last night, so if you downloaded it before that, you may want to re-download it because a few things changed that I had to make an update for. And so the idea here is that as we go along, you could write down, the different dates and numbers that we discover together. And then later on, 6 months, a year later, when you come back and you're trying to remember like what you learned in the seminar, you can pull out the sheet, and it's kind of a summary of all of the numbers that you learned. And so the way to get to the worksheet is to go to acera.org/seminars. So I'll go ahead and paste that in there for you. And then just go down to the pre-retirement webinar and go to the retirement planning worksheet. Okay. So going back to the presentation, your ACERA entry date, now that you know what that is, it's the first day of your second pay period. If you happen to know what that is, you can go ahead and write that in there. It is in your online account if you log into your account on our website. Or if you're just going along with the video, the entry date isn't like critical in a lot of cases because you're going to, earn way more retirement and you're going to go way past your retirement eligibility date. So you could just do an approximate date here. If you happen to know, like it's November of the year 2001 or something, you could write that in. Okay, and then for projected retirement date, if you happen to know that right now, like you already have a date in mind, you could write that in right now as well. You may want to pencil it in because you might learn something during the seminar that helps you change your mind on that retirement date. A couple more things about vesting. I said it's after 5 years of service credit. That includes reciprocal service credit, and we'll mention reciprocity later on. But it's when you have different California retirement systems linked together. So the service credit from all of those combined gets you over the 5-year mark. And the guarantee of the vesting means guaranteed, it's by state law. And so the vested benefits are that retirement allowance you're going to get every month for the rest of your life, the cost of living increase to that retirement allowance, which I will talk more about later. So that's annual. And then a $1,000 lump sum death benefit. And there are other death benefits that go along with the different retirement options. So now that you know your vested date, it's simply 5 years after your entry date. If you worked full time, you can put that in here if you like. The vested date isn't super important as long as you know you're past the vesting date. Okay, now another basic piece of information that you're going to want to know is what tier you're in. Your tier is based on your date of entry into a SARA. And the first thing you're going to do is find out which timeline you're on here. So safety members are sheriff's deputies and probation officers and perhaps other sworn officers. Everyone who's not a safety member is a general member. There are some general members, though, that work for the Housing Authority and Livermore Area Recreation and Parks District. And so you would want to look at these two timelines here. So now that you've narrowed it down to your timeline, the way it works is if you entered a SARA before the date that marks the next tier, then that puts you in the earlier tier. So for example, if you're a general member who entered a SARA before July 1st, 1983, so June 30th, 1983 and before, basically, then that puts you in tier 1. If you entered a SARA July 1st, 1983, all the way up to December 31st, 2012, that puts you in tier 2. If you entered a SARA January 1st, 2013 and beyond, that puts you in tier 4. And that's the case with all of the timelines. Now, the Housing Authority and LERPD have a few different, have a couple different cutoff dates that you can check out there. And for the safety members, if you entered a SARA October 17th, 2010 to December 31st, 2012, you had a choice of tier 2C or tier 2D. And if you don't remember which one you chose, you can log into your account on our website and it will tell you which tier. For everyone, if you log into your account on our website, it will tell you which tier you're in. Okay, so now that you know what tier you're in, you can go ahead and mark that on your worksheet if you like. And for safety members, you may have a split tier. You may have done some general work and some safety work. You can fill out one worksheet or you can do 2 worksheets if you want. Okay, next item on the checklist, estimating your benefits. So let me help you understand how your retirement benefit is going to be calculated and help you get a personal estimate for what your retirement benefit is going to be that you've been earning throughout your career. The first thing I'll do is explain how we calculate your retirement allowance. And I'll kind of throw out the term retirement allowance, retirement benefit. It's the exact same thing. So this is the formula that we're going to use. And this formula can be summarized in this sentence. In retirement, you're going to get a percentage of your highest salary for each year of service that you work. Okay? Percentage of your highest salary for each year of service that you work. So let me give you an example. Let's say that the percentage of your highest salary that you're going to get for each year of service that you work is 2%. And let's say that you work for 20 years full-time, so you earn 20 years of service credit. That means that you're going to get 2% of your highest working salary for each one of these 20 years. Okay? So 2% of your salary for each one of the 20 years, that means when we multiply them together, you're going to get 40% of your highest average monthly salary in retirement. So whatever you were making before retirement every month, you're going to get 40% of that every month in this example. Now, to give you some more numbers, let's just say that your working salary was $5,000 per month. 40% of $5,000 is $2,000. So this was your working salary, and 40% of that becomes your retirement allowance, $2,000. And you'll get that every month for the rest of your life, plus cost of living increases. Okay, now let me give you a little bit of detail about each one of those factors in the formula, starting with the age factor percentage. What I want to tell you about this is that first of all, this is an age factor percentage chart, okay? But you're not going to look at, yes, and this is gross salary to answer your question. So we're talking about gross salary. Okay, so regarding the age factor percentage, you're going to ignore all the other numbers except for the column for your tier. So if you're a general member and you're in tier 2, you only look at this column of numbers, for example. Okay. And the way this works is when you go to retire, we're going to use this chart to figure out what the percentage of your highest salary is going to be for each one of your years of service. So let's say, for example, you retire at age 65 from tier 4 and you're a general member. We're going to come over here to the chart. We're going to go to tier 4, go to general members. We're going to come down to age 65. We see that it's 2.30%. That is the percentage of your highest salary that you're going to get for each year of service. That's what we put in the formula for you. Now, you'll notice that the numbers get bigger the older you are when you retire. So the longer you wait to retire, the older you are, the higher the percentage is going to be that we're going to put in the formula for you. Another thing that you'll notice is the percentage maxes out at a certain point. So, for example, tier 2, general members max out at 2.43% at age 65. If you retire at 65 or older than 65, we're going to use the 2.43% in the formula for you. The final thing that you'll probably notice is there's a bunch of gaps in the ages here. And there's this sentence up here: the percentage increases every 3 months based on your birthday. So really, if this is just a sample of some of the age factors, if this were the full chart, there would be an incremental increase to the percentages for every quarter year. So this would say like 52, 52 and a quarter, 52 and a half, 52 and 3/4, 53, and so on and so forth. And there would be a slight increase to the percentage every quarter you wait. So, and it's based on your birthday. So if your birthday is January 15th, for example, 1 quarter after your birthday is April 15th. So you pass that day, you go up 1 notch in the chart, get a slightly higher age factor percentage. Then July 15th, 2 quarters after your birthday comes around, you go up another notch. October 15th comes around, you don't retire yet, you go up another notch in the chart, and then back to your birthday. So every time that one of those 3-month incremental days passes based on your birthday, then you get a slightly higher age factor percentage up to the limit. Okay. And if you want to see what all the age factor percentages are, you can always find those on our website. Okay, so that's the age factor percentage part of the formula that I wanted to, the details about how that works that I wanted to tell you. The bottom line is that the older you are when you retire, the higher the percentage of your salary that you're going to get for each year of service, up to the limit. Okay, now let's talk about the service credit number. You start earning service credit on your date of entry in Acera. As soon as you start working, your first 15 minutes of work, you earn 15 minutes of service credit. Okay. Now you're going to keep earning service credit as you work in your position, all the way up until your retirement date. Really, it's going to be you're earning your service credit all the way up until your date of separation. And so a lot of people go straight into retirement. So you earn service credit right up until the day before your retirement date. But if you are one of those people, and there are some people that do this, there are many that stop working and then defer their retirement to a later date, you do have that option. Then there would be an additional milestone here where you would earn service credit all the way up until the date that you stop working. Okay. And then you have your retirement date. So you're going to be earning service credit during this period. Now you earn service credit while you work your regular work hours. And you also earn service credit during your earned leave times, such as vacation, sick leave, management leave, comp time, holidays, floating holidays. All of those types of time, you're already earning service credit while you're out on that leave. It does not count against you for service credit, okay? So you don't have to worry about that. Now, there are some types of time that you do not earn service credit, and that's whenever you're out on leave without pay, you're not earning service credit. If you take a purchased vacation, so that this is where you purchase additional vacation on top of your earned vacation, then you're not earning service credit while you're out on that purchased vacation time. So anytime you're marking purchased vacation on your pay stub, you're not earning service credit for that time. Now, sold vacation, you do have the option of selling your earned vacation for cash. And sorry about that. Let me go ahead and turn my ringer off. Sorry about that. Now, if you sell your earned vacation, you get cash, but you don't get service credit for that. You may get salary credit for it in the formula, which I'll talk about in detail pretty soon, but you do not get service credit for it. And you also don't get service credit for overtime, on-call time, or standby time. Now, there are some types of time that are eligible for you to purchase to increase your amount of service credit, because the more service credit you have in the formula, obviously, the higher your retirement allowance is going to be. And some examples of those are part-time work that you did where you weren't under contract, you weren't working for a temporary agency, it was just plain old part-time, or you worked for the county's temporary assignment pool, or project work before your full-time position, that's purchasable. That 2 weeks between your date of hire and your date of entry, unpaid leave in the categories of medical leave, disability leave, and military leave. When you return from that leave, you can purchase that time. Redeposits of prior membership, also redeposits of if an ex-spouse takes a refund of their community property that was part of your retirement, and time working for other California public agencies. I'm not going to take a deep dive into purchasing service credit in this seminar. I do take a deep dive into this in the new employee / mid-career seminar, so you can go back and watch one of our videos on that, and you can just fast forward to that part. Or you could just go to our website, sarah.org/purchase, and we have all the details of purchasing service credit on that site. Okay, and I do have a question, which is really great timing. What happens to your accrued sick leave? Do you get service credit for it? Do you get salary credit for it? Well, you don't get salary credit for it, but you can get service credit for it. And the way that you get service credit for it is, first of all, you're going to go straight into retirement. So this is only for people who are planning to go straight into retirement. If you're going to stop working and defer your retirement to a later date and become what we call a deferred member, then you're just going to lose all your sick leave. Okay, so sorry about that. If you are planning on going straight from active work into retirement, which means that the first day of retirement is the next day after your last day of active employment. So this is basically your last day on payroll. So your last day on payroll comes directly before your first day of retirement, is another way to say it. That means you're going straight into retirement, and we will convert your sick leave on a 2-to-1 basis to service credit. So you're basically going to get half of your sick leave as additional service credit in the retirement formula for you. Now there's a cap on how much sick leave is convertible. And the cap is in your memorandum of understanding, which is what MOU stands for. So we can consider sick leave up to the cap. And then what we do is we divide it by 2, and that's how much additional service credit we put in the formula for you. So to give you an example, in a lot of the MOUs, the cap is 125 days of sick leave. So we're allowed to convert 125 days of sick leave. So we divide it by 2. That gives us 62.5 days of additional service credit to add to your service credit. And it's business days, not calendar days. And so that equals about, a little over 12 work weeks. That's about 3 more months of service credit. Okay, roughly. So that the sick leave conversion, can be fairly powerful. There is one MOU I happen to know off the top of my head. It's Accrue, and there is no cap on how much sick leave is convertible in the MOU. There's no cap. And so the unrepresented managers that go along with Accrue, there's also no cap. But everyone else, you're going to have to look in your MOU. And you can ask your human resources department for a copy of it if you've never seen it. So that's how that works. Okay, we talked about the age factor percentage. We talked about the years of service credit. Let's talk about the highest average monthly salary component of the retirement formula. When we go to calculate your retirement, what we need to do in order to calculate your highest average monthly salary is we need to find your period of highest pay during your career. This is known as your final compensation period, okay? For tiers 1 and 3, your final compensation period is going to be your highest 26 biweekly or 12 monthly pay periods, depending on how you're paid. So it's the highest consecutive pay periods. For tiers 2 and 4, it's the highest 78 biweekly or 36 monthly pay periods. So essentially for tiers 1 and 3, it's your highest year of pay. And for tiers 2 and 4, it's your highest 3 years of pay. Now, in order to calculate this number, highest average monthly salary, we simply take the total pay that you received in that 1 year or that 3 years, and we divide it by the number of months in that period, and that gives us the average. Pretty simple. So for tiers 1 and 3 divided by 12 months, tiers 2 and 4 divided by 36 months. So now we have your highest average monthly salary number. And just to remind you all, this is gross salary that we're looking at. Now, the pay types of your gross salary that will be included in this calculation are as follows. Your base pay, of course, is going to be included in the calculation. And then for some of you, you have other pay types that have other pay codes associated with them that you might see on your pay stub. These are sometimes known as footnotes. Now, some of these may be included and some of these may not be. And I can't tell you off the top of my head which ones are in or out because there's like 1,000 pay codes. But the way you can find out for yourself is go to our webpage, acera.org/pay codes. And there is a list there for each one of the 6 employers we have. And you can find your pay code on the list and it'll say yes or no, whether it's in or out. The one pay code I do know that never counts is overtime. Okay, 2 more bullet points here. These 2 types of pay may be included in your highest average salary calculation if you're in tiers 1 or 2. It's not tier 4 because the law that was passed in 2012 that created tier 4 got rid of this for tier 4. So you all can't do this. And for tier 3, you're not allowed to sell vacation. And so you're not included in this either, unless you all were able to renegotiate that. Now, so these 2 types of pay are vacation sales and vacation cash out. This is you, and a tier 4 members, you can take a little nap if you like, because we're going to talk about this for maybe 15 minutes. So the two ways that you can get paid, we're talking about getting paid for your earned vacation. These are your vacation accruals that you earn gradually as you work. Okay. There's 2 ways you can get paid for your earned vacation. The first is called vacation sale or vacation sell. And this is when you sell your vacation back to your employer while you're still employed. The second way that you get paid for your earned vacation that you're not going to use is called vacation cash out, sometimes called vacation payoff. And this simply means that you haven't taken the vacation or haven't sold it at the time of termination. So you still have it on the books when you stop working, and they will cash you out for it at that time because this is an earned benefit that you will receive cash for. Now, when we're talking about the vacation sales and vacation cash out in terms of whether or not this is included in your salary calculation, we're just looking at the vacation sales or vacation cash out that occur during your final compensation period. Now we're looking at the combination of the 2, the total. And this is your total vacation compensation between selling vacation and getting cashed out for it at the time that you terminate and or retire. Okay, the idea here is that if you get paid for your earned vacation during that final compensation period, that makes your total salary during that final compensation period get larger. If your total salary gets larger, your average salary gets larger over that time. If your average salary is larger, Remember, your highest average monthly salary is one of the three multipliers in the retirement formula. That makes your retirement allowance go up. So the bottom line here is that the effect of getting paid for your earned vacation during your final compensation period means a higher retirement allowance. How much higher? Well, this chart gives you an approximation of how much higher it might get. So for example, if you were able to include 5 weeks, if you're tier 2, and you were able to include 5 weeks worth of vacation sales, and 5 weeks worth of vacation compensation between sales and cash out in your salary calculation, that would increase your retirement allowance by about 3.2% at the time of retirement and for the rest of your life. So you can see how the number goes up the more weeks of vacation you're able to include. And for tier 1, it has a kind of accelerated effect because you were just looking at a 1-year final compensation period. Okay, so this kind of gives you an idea of the effect of this. Now there's a cap that's written into the law on how much vacation compensation a SARA is allowed to include in your salary calculation. The law also says that we must include this. So if you get paid for vacation during that final compensation period, your unused vacation, then we have to include it. Okay, but we also can't include more than the limit tells us. Okay, so let me help you understand what the limits are. And I see a question on the board. Let me go ahead and get to that question after I finish this explanation, because I'm going to explain kind of the ins and outs of this vacation compensation a little bit more. Okay, in some greater detail. Okay, so here's how you find your limit. Your cap is going to be personal to you based on your work situation. So the first thing I'm going to do on your retirement planning worksheet, I'm going to show Alameda Health System employees how to find your cap. Okay. So what you do is you go to the worksheet, and the one number that you need for this is your hours of PTO that you're in per pay period. So Alameda Health System employees, the sick leave and vacation is lumped into one bucket. It's called paid time off, PTO. And so you just look at your pay stub and it will show you how much PTO that you earn per pay period. Okay. And all you need to do is put that in here. Okay. So in this example, it's 6.7692 hours of PTO per pay period. And then for tier 1, to find your limit in hours, your total limit in hours, you just multiply it by 13. That gives you 88 in this example. For tier 2, to find your limit, you multiply it by 39. That gives you 264 hours in this example. Now, what does the 13 and 39 stand for? The 13 is basically half a year's worth of pay period. So it's half of 26. And the 39 for tier 2 is a year and a half's worth of pay periods. So that's 26 times 1.5. And so that gives you your total limit on the total amount of vacation hours worth of vacation compensation we are allowed to include as salary in your salary calculation. Now, there's one exception. AHS employees who work for the who are in the UAPD union, your caps are just kind of flat. You have flat caps. Everyone in the union has the same cap. And for tier 1, it's 120 hours of PTO, and for tier 2, it's 360 hours of PTO. Okay. So now Alameda Health System employees, now you know how to find that. Okay, now let me do everyone else. Everyone who works for the county and our other employers, here's how you figure out what your cap is going to be. And like I said, it's going to be individual to you. So you go to your worksheet, you go to this part of the worksheet, county and other employees. And there's a little grid that you have to fill out here. And you basically need these two numbers, or kind of two sets of numbers. You need how much vacation you earn per year. Okay, so most people know what this number is. I earn 3 weeks of vacation per year, or I earn 4 weeks of vacation per year, or 5 weeks of vacation per year. Okay, so you go ahead and put that in here. Now, this number right here, payable, this is the weeks of vacation you're allowed to sell per year. Okay, so your employer has a rule somewhere and they will let you sell some of your vacation annually if you want to. And so you just figure out what that rule is. And if you don't know what it is, you can ask your payroll clerk, they will know. And so in this example, I just say your employer lets you sell 2 weeks of vacation per year. Okay. So for tier 1, you just have to fill out these 2 numbers. Now for tiers 2 and for tier 2, you're going to need to fill this number out for each 12-month period in your final compensation period. So you think about that 3-year final compensation period. And the way to think about it is you take your retirement, if you're making the highest pay in your career, at the end of your career, it's just going to be your last, and you're working full time, it's just going to be your last 3 years of work. And so you take your retirement date and you go 3 years back into the past, and then you just look at each one of those years. So if your retirement date is going to be September 13th, 2021, then year 3 is going to be September, like basically September 13th, or September, let me see, it's going to be September 12th, 2020, all the way up to September 13th, 2021. And so you just think about that period, and you think about how many weeks of vacation you're earning per year during that time, and then how many weeks of vacation you're allowed to sell per year. Now, you don't have to, like, I'm telling you to think about your final compensation period and break it down by year. A lot of you are not going to have to overcomplicate this, because these numbers are all going to be the same for you, because the amount of weeks of vacation that you're earning per year isn't going to change. And then your employer's rule about how much you can sell isn't going to change. But you do need to break it down by year for the calculator that I'm about to show you. So it's I just wanted to explain how that works if these numbers are going to change over this period for you. So you can put in different numbers. Like for example, somebody might have been working, earning 4 weeks per year in tier 1. I'm sorry, 4 weeks per year the first year, 4 weeks per year the second year, but then they got over that seniority mark to start earning 5 weeks per year, and then it becomes 5 weeks. Okay, so you just put all those numbers in. Okay, then what you need to do is you need to get your limit from this calculator that we have on our website. And sorry that the worksheet still says chart down here. We used to have a chart, but this stuff changed a couple of months ago. And so we created these calculators, and now we have calculators that help you do this. So this is what it looks like, but I'm actually going to go out. This is just a screenshot. I'm actually going to go out to the calculator and show you how to do this. So what you need to do is type in acero.org/vacation. Okay, now since we're still talking to Alameda County Courts Housing Authority employees, we're not talking to AHS employees. You just pop open this tab here, this little accordion, and you have a calculator for tier 1 and you have a calculator for tier 2, and you just plug those numbers in. So in the tier 1 example, you type in 5, you earn 5 weeks per year and you're allowed to sell 2, and it will tell you what your limit is, 2 weeks. Now for tier 2, we'll just go ahead and do the same thing. We'll stick with the same example. You plug in 5 weeks. You're allowed to, you earn 5, you're allowed to sell 2, you earn 5, you're allowed to sell 2, you earn 5, you're allowed to sell, you're allowed to sell 2, and then it gives you your limit. In this example, the limit is 6 weeks. I could tell you how the calculator is working. What it's doing is it's taking the lesser of these numbers in each 12-month period and adding the lesser one up. So in all 3 of these 12-month periods, the lesser number is 2. And so it's just 2 plus 2 plus 2 is 6. So that's the way the calculator works. That's how the tier 1 calculator works. It's just taking the lesser of these 2 numbers. Okay, so now that you know what your limit is, we'll stick with the tier 2 example since the vast majority of people are in tier 2. And let me go back to the presentation and show you how to plug this in. Okay, so on your worksheet, you just plug your limit from the calculator right here into this limit field. So now we know your limit. So like I said, you're all going to get a little bit different number out of the calculator. And whatever your number is, you plug it into the worksheet right here. Okay, now you know your limit. What do you do with that limit? Well, you can just totally ignore it and just take all your vacation, and it's totally fine. And you'll just get a retirement allowance calculated without any additional vacation compensation in the salary calculation. But if you are somebody who is interested in this boost that selling and or cashing out vacation gives you, then you just think about, okay, well, how do I get paid for my vacation, my earned vacation, to get, up to the limit? And so the simplest way to do it in the vast majority of cases is to simply just have that amount on the books, have your limit on the books at the time that you stop working. So in this example, you would just have 6 weeks worth of vacation on the books. That would get you up to your limit, and you don't have to worry about selling any vacation. So you just sell 0. Now, there's another scenario. Let me give you a slightly different scenario. A few of you might be in this scenario where you can't get up to your limit simply by cashing out. There are some scenarios where that happens, and this is one of them. This scenario is in this particular scenario, you're earning 4 weeks of vacation per year, and you actually are allowed to sell more. You're allowed to sell 3 weeks of that vacation per year. Now, if we do the calculator and we look at the limit from the calculator, the limit is going to be 9 weeks worth of vacation, because the lesser of all 3 of these numbers in each 12-month period when we compare them is 3. So 3 plus 3 plus 3 is 9. Okay. Now, there's this additional rule that you have to consider, which is that your employer will not cash you out for more than 2 times your accrual rate. So this person earns 4 weeks of vacation each year that they work. 2 times 4 is 8. So 2 times their annual accrual rate is 8. You see that they can't get up to the 9 that they could that we could include in their salary by simply cashing out. Because if they have the 9 weeks of vacation on the books when they stop working, that extra week of vacation is going to go poof. It's going to disappear. They won't get anything for it, okay? Because they will only cash you out for 2 times your accrual rate. So, okay, somebody said I'm frozen. Am I still frozen? And what did you miss hearing? Let me check on this. Seems okay. Let me know if you missed hearing anything. And then there is a quick question here. If we're talking about tier 2, does that include tier 2B safety members? Yes, it does. Everyone who's labeled tier 2, that includes tier 2 safety. Okay, great. Okay, and then let me just, okay, I'll go through the rest of the questions after the explanation. So the way that in this scenario to get up to your limit is to simply sell 1 week of vacation. You probably already guessed that. You sell 1 week of vacation while you're still employed, have 8 weeks on the books when you stop working, and that gets you to a total of 9 in this example. The vast majority of people are not going to be in this scenario, but there are a few people that might be in this scenario. Okay, so you have to figure out whether you can get up to your limit or not from simply cashing out. For tier 1, this doesn't matter because we're only talking about a 1-year final compensation period. And so you can easily get up to your limit without going over this 2 times your accrual rate max. So this is just for tier 2 people, this consideration. Tier 1 people, you still don't want to have more than 2 times your accrual rate of vacation on the books when you retire, because you will lose everything above 2 times your accrual rate. But you don't have to you don't have to overthink this vacation compensation thing. Okay, so then I usually get the question, well, I already sold a bunch of vacation. What do I do? So sticking with that same example, what would you do if you, rather than, just selling the 1 week of vacation and cashing out 8 to get up to the 9, or even in the previous example where the limit was 6, if you sold, vacation, what do you do if you already sold a bunch of vacation? Well, you have 2 options. Option number 1 is to simply cash out the difference. So in this example, this person's limit of how much vacation compensation we're allowed to include in the salary calculation is 9. They've sold 5 while they're still working during their final compensation period. And so you just subtract 5 from 9 to get 4. You just cash out the rest. So you just have 4 weeks of vacation left over on the books when you stop working, and that gets you up to the 9. Option number 2 is if you want to cash out more than that, that's okay. You don't worry about it. And so you sold 5 weeks of vacation, but for whatever reason, you're going to have, more than this 4 on the books. Let's say that you have 8. And so you're not going over 2 times your accrual rate, which we want to make sure that you're not doing. This is totally fine. What's going to happen is when you sell your vacation while you're still employed, you're going to get 5 weeks worth of vacation pay in your paycheck. That's going to go into your bank account. Then when you stop working, you have 8 weeks on the books. You're going to get 8 weeks worth of vacation pay. They're going to write you a check for that. That goes in your bank account. That's great. Now, still, the law tells us what the limit is. Okay, it's pretty clear on this. We still have to limit the amount of that compensation that you received to 9 weeks worth. So you got paid 13 weeks worth total. So we're going to just take 9 weeks worth of that 13 weeks. Basically, this is kind of like essentially the short version of how it works. And put that in your salary for the salary calculation. Okay, so you still get all the money and you have maxed out your limit of how much vacation compensation we're allowed to include. There actually is a third option, which is you don't have to do anything else. You could just sell the 5 weeks, cash out 0, and you would get up to, we would include 5. You wouldn't get up to your limit. We would include 5 weeks worth of your vacation. I should add that in here as an option. We would just include 5 weeks worth of vacation pay in your salary. You wouldn't have gotten up to your limit, but you would have gotten a little boost. So, about a 3% boost to your retirement allowance. So that's how that works. Okay, now that concludes my prepared remarks on this topic. So let me go to the questions. Okay, first question is not about vacation. It's about reciprocity. So you're a deferred member with Acera. You currently work for Santa Clara County. And the question is the and you have reciprocity. The question is about, will the highest average salary for your current employer be used in calculating the retirement that you're going to get from Acera? And the answer is yes. That's one of the powerful benefits of establishing reciprocity. So when we go to do your benefit calculation for Acera, we're going to use your age factor percentage in your tier here based on your age at retirement. We're going to use the years of service credit that you earned with Acera, and then we're going to use your salary from Santa Clara County if that's the one that's higher. Okay, so back to the questions on vacation. So the question was, what is the cap now for tier 2 safety? Well, you probably learned from the presentation that it's all individual to you based on your individual situation. Okay, there's another question. So you're confused. If you plan to retire in 3 years, do you accrue to the limit or sell or cash back each year? Okay, so to this question, like I was saying, in most cases, as long as you can get up to the limit by cashing out, you just do that. Don't worry about selling vacation back to your employer. Okay, so you calculate your limit now. You have 3 years to plan. And you know what your limit's going to be, and you just simply plan to have that much vacation on the books when you retire. So that's easy. Unless you're in this situation where you have to sell a little vacation to get up to the limit. And then you may want to do that. You may want to consider doing that. So that's by far the easiest way to think about it, I think. Okay, let's see. There's a question. Can we call someone in Acera to help us figure out vacation sell back? Or is this an HR conversation? If you're asking about how to actually physically do the vacation sellback, that would be a question for your employer, probably your payroll clerk, but it could be your HR representative. Um, so so if that's your question, like how do I sell back? What form do I fill out? What's the timing? Um, then that would be a question for your employer. Now, if you're asking, can someone help, sit down and do my personal scenario and help me figure this out? Then you could contact us, Sarah, and we can help you do that over email or over the phone. Or if you want to hang around after the presentation at 12:45, I can take you through it as well. Question is, will this calculation still work if you're only allowed to sell 2 days per year? I think I'm going to take a wild guess here, and I'm going to guess that I'm going back to our website here. You work for the courts, maybe? And so the courts limit is, and let me know if that's correct or incorrect. So the court's limit would be based on, it's set forth here. So for tier 1, it's 1 day's vacation pay, and tier 3, it's 3 days vacation pay. And let me know if that doesn't apply to you. Okay, yeah. So yeah, the limits are here. Tier 1, 1 day's worth of vacation pay. Tier 2 is 3 days worth of vacation pay. Okay, so going back to the presentation. Okay, the question is, when should I sell my vacation to maximize my pension as a tier 2 safety member? And that you understand straddling is no longer allowed. Yeah, so the way I'm explaining it here is without straddling allowed, because that was a decision that was made back in June. So everyone who retires, I think the cutoff is June 17th and beyond. I think it's June 17th, 2021. Then the straddling is no longer allowed. So you just go by this explanation of how to determine what your limit is and when to cash out versus sell. And so, like I was telling the person earlier, in most cases, you're just going to want to focus on the cash out unless you're in this situation where you can't get up to your limit from simply cashing out and then you sell. But you don't have to worry about like timing a bunch of sales anymore, because the limits are, based on what the state wanted to happen, the limits are low enough now where in the vast majority of cases, you can, mostly reach your limit through just the cash out alone, or the cash out and a little sale. Okay, so the question is it best to sell vacation or cash out to get the salary boost for the highest average salary at retirement? So I think it's best to cash it out, because you're getting paid more for it. A little bit more because of the fact that when you cash it out, you're probably making a higher salary than you were at the beginning of your, tier 2, 3-year final compensation period, if we're talking about tier 2. But that actually may no longer be the case, because we are calculating the dollar limit on vacation differently post June 17th. And I think it's actually going to be based on what you physically would have been able to sell. So I think it actually doesn't matter anymore. So I'm going to say that I'm like 90% sure it doesn't matter whether you sell or cash out your vacation. It's going to be the same dollar limit either way. But I will clarify that in a later seminar. And if you want the exact answer to that, you can, I'll give out my email address during the break time, and you can email me that you're interested in having the exact answer to that. Okay. So the question is, do I have to pay taxes on my retirement earnings? Yes, you do. because you are contributing to the retirement system on a tax deferred basis. So your retirement contributions are coming out of your pre-tax deductions. So you're not paying taxes on those contributions going in. So then you're going to have to pay taxes on the disbursements from the retirement system when you collect your retirement allowance. Okay, now let's see. Next question. Let's say you do both vacation sell plus vacation cash out. Since vacation cash out is higher, will that be the calculation that Sarah uses? That's kind of the same question from earlier, like dollar-wise, is it better to cash out? I think that's not going to matter anymore. Like that's my kind of educated guess on this. If I'm thinking about the way we're calculating the dollar maximum now. But like I said, I will, you can email me about that and I'll pass out my email during the break time. Okay, is the vacation sell cap by fiscal or calendar year? Okay, interesting question. So I didn't mention that earlier. The vacation sell cap is by fiscal year. So that is your employer's limit on how much vacation you're allowed to sell per fiscal year. In the example we're looking at, their limit is 3 weeks of vacation per fiscal year. Now, to answer the person's question down there, they were curious what straddling is, so what we were talking about. Prior to June, we would consider the fact that you were straddling 4 different fiscal years because you weren't retiring exactly lined up with the fiscal year. And so you did have the possibility of selling vacation under your annual fiscal year limit in 4 different periods within your final compensation period. But, based on the action the board took in June, based on, what the state was, kind of getting at in terms of what they wanted to see the Attorney General's office, based on what the interpretation of the law is that's on the books, then we can't do that anymore. So we're just simply looking at what the rule is for you to sell in 3 different fiscal year periods for tier 2 or 1 fiscal year period for tier 1. And that's the limit that you're going to use. Let's see. If you can't get up to the limit, can you sell vacation back during your last year? Absolutely. And in fact, that's probably the easiest way to do it. And that's exactly the example we're looking at right here, is this person can't get up to their limit of 9 weeks worth of vacation by having the 8 weeks that they're allowed to have on the books at the time of retirement. And so like once you can kind of see that occurring, you can plan to sell that, extra week of vacation or whatever it is for you in that last year prior to retirement. And in this person's case, they're allowed to sell 3 weeks per fiscal year, so they could easily sell 1 week that last year. Okay, let's see. What is the boost for 8 weeks for tier 2? So I think you're talking about going back to the chart. This one. So 8 weeks for tier 2, about 5%. It's a pretty interesting boost there. And that is at the time of retirement and for the rest of your life. And then you will get cost of living increases on top of that larger amount. Okay, next question. Will the dollar limit be based on the lowest salary or highest salary or average? So just to be clear on this dollar limit thing, I think the way it works is we're going to look, like for tier 2, for example, we're going to look at the 3 12-month periods. So we look at your whole payroll grid for that 3 years. We divide it into 3 12-month periods. And then what we're going to do is we're going to see what the maximum amount that you could have included. So we're going to look at how many weeks of vacation you earn per year versus how many you're allowed to sell per year. And in almost every case, the amount that you sell per year is going to be less than the amount that you earn per year. Okay, so we'll stick with that example. So the amount that you're allowed to sell per year, now we're going to look at, in that 12-month period, what was the maximum dollar amount that you would have been allowed to sell if you had done it. Theoretically, hypothetically, so you don't even have to sell a vacation. We're just like doing a calculation of how much you could have got paid had you sold that maximum vacation you're allowed to sell in that 12-month period. Okay, so we find that dollar amount. We do that for the other two 12-month periods. So we get $3 amounts, we add those up, total them. And that tells us what the maximum dollar amount is of vacation compensation that we're going to be allowed to include in your salary calculation. So that actually is the exact way that we're calculating these now. So that's why I think that it doesn't matter whether you cash out or sell, because you're not really looking at the differential between, the higher pay later, because it doesn't matter, because we're calculating it based on what you could have sold. Okay, another question. If you sold the maximum by fiscal year, 3 weeks per fiscal year in this example, and it equals 6 weeks in the calendar year, in your final year, and your cap is 9 weeks with the new rules, how will that impact your limits if you're in your final year? What equals 6 weeks in the calendar year? Because let me move ahead here. So you're kind of in this example, you're selling 3 weeks, 3 weeks, 3 weeks. Your limit is 9. What is the 6 week part? I'm not quite following that. The total you already sold was 6 weeks in the calendar year. So the calendar year doesn't really make a difference here anymore. We don't really care if you sold 6 weeks in the calendar year. That's fine. And if your employer lets you sell, the 3, 3, and 3 in the fiscal year, that's what they let you sell. We're simply looking at the payroll records that come through whenever we're calculating your retirement, and we'll see that you sold 3, 3, and 3. And then if this is kind of your example, you're in this situation, we'll see that your limit is 9, and we'll see that we can include 9 weeks worth of vacation pay in your salary calculation, basically. So it doesn't matter that you sold 6 weeks in a calendar year. Okay, and if a tier 2 member earns 5 weeks per year and can sell 3 weeks per year, if they retire with 10 weeks, the max they can carry will that maximize their salary spike. Okay, so in the example you're giving me, they earn 5 weeks per year, and they're allowed to sell 3 weeks. Okay, so the thing here is that they're not really any different than this example, because even though the 5, 5, and 5, we're still looking at the lesser of each one of these categories in each 12-month period, and so their limit is still going to be 9. And so even though they cash out 2 times their accrual rate is going to be 10, they can cash out 10 if they want, but we're only going to be able to include 9 weeks worth of vacation pay in the salary calculation. But if that is your example, then that makes it easy for you, because you can get up to the limit simply by having 9 or 10 weeks on the books, but only 9 weeks worth is gonna allowed to be included as salary in the calculation. So there's no way to get around what this limit is by having more on the books, if that was the question. Okay, and then there's another question. When you retire, if you cash out vacation, do you receive a separate check for the vacation cash out, or is it included in your retirement salary? It's not included in your retirement check, which is going to come separate from a SARA. You're going to get cash out from your employer. So I'm not sure if they send you a separate check for the cash out, which is, we're talking about this here, or if they just include that as they lump it into your final check that they're going to send you like 2 weeks after you quit and are done working. So I'm not exactly sure whether it's a separate, but it's not going to come from a SARA. It'll come from your employer. Okay, so I'm going to go ahead and move on. And Tier 4 members, welcome back. Sorry that took so long, but there's a lot of ins and outs of that topic. So if you have more questions on that, we can talk about that during the break time or after the seminar. Okay. There's a question, can you elect to put your vacation cash out into deferred comp? I don't know the answer to that, but that is a good question for Gene Hilliard, who's going to be coming on at noon to discuss the deferred comp plan. So we can ask him when we get there. Okay, and one more thing that we'll talk about, and then we'll take a break. This last part, there are some limits on your benefit, limits to your monthly retirement allowance, your retirement benefit. And those are listed out here. And so I'm not going to spend a lot of time on this, but one kind of the basic limit is that your retirement allowance can't be more than 100% of whatever we calculate your highest average monthly salary to be. The idea here is trying to make it so that you can't earn more in retirement than you were making while you were working. And that's true. Except for, remember we were just talking about how your highest average monthly salary might be a bit higher from that vacation pay. So, that's a consideration in there. So it actually might be a bit higher. But otherwise, the basic idea here is that your retirement benefit is capped at 100% of your highest average monthly salary. Most people don't hit this cap. You got to work like 35, 40 years to hit it. So most people don't have to worry about that. Okay, the people with high salaries, there are a couple of limits here for you that you can explore on your own. I'm not going to get into that too much. And then for Tier 4 members, there is a limit on how much of your salary we are allowed to include for the purposes of calculating your retirement. And so there's these two maximum dollar figures here. This is in annual salary numbers. If you are a general member and make more than $128,059, and for safety members, $153,671. Any salary beyond that for that year, we cannot include in your salary calculation for the purposes of calculating your retirement. And that's just a Tier 4 rule. Now, that's the bad news. The good news is that we don't take retirement contributions out of any salary above that. So that gives you extra money to save in your 457B plan. Okay. Any more details on the limits, you can check out on our limits page. Okay, now I'm going to show you two ways to estimate your retirement allowance. The first way I'm going to show you is this kind of way to get a ballpark estimate of kind of what level of salary replacement you are achieving. What you do is you go to your worksheet and you go to this area right here, estimating my retirement, and then this get a ballpark estimate. You put in your age. In this example, we're going to do 58. You put in this scenario, you think, well, okay, I'm going to be age 58. How many years of service credit will I have earned in this scenario where I'm retiring at age 58? And in this example, it's 29. And so we take these two numbers and we go to one of these ballpark percentage charts out on Acera's website. And I'll show you where to find those. Okay, here's our home page. Just hit get started. This is one of two places to find these on our website. You scroll down and you find the number for your tier. Okay, so let's see, what tier was I doing? Don't remember. I'll do tier 2A. And in this example, I was retiring at 58 with 29 years of service. So I'm just going to find where those two intersect. And that means that I will achieve 50.03% income replacement. So that means that whatever I'm making before retirement, if I retire at age 58 with 29 years of service credit, I will get 50% basically of my highest average salary in retirement. And then another way to use these charts is once you find where those intersect, if you want to see what happens if you work an additional year, you just go diagonally down the chart. So if I work another year, I'm going to be another year older and have another year of service credit. I'll get 54.5% of my salary. If I work another year, 59.42%, and so on and so forth. But we're working with 50.03% in this example. So you just come back to the worksheet, you plug in where those intersected. And so you could stop here if you wanted, because one of the ways to think about retirement is trying to achieve 70 to 80% income replacement between the combination of your ACERA retirement, your Social Security, and any other savings. But if you want to, you can do the extra part just to see what the dollar amount, you get a ballpark of the dollar amount is, and you can put in your highest average monthly salary. Now, one way to get this is to actually do this calculation in our benefit estimator in your account on our website. But as long as you're in there, you might as well just do our retirement calculator. So if you're just getting a quick estimate, you just kind of think about your monthly salary off the top of your head, and you can just kind of you can just think, I'm going to get in this scenario half of my salary, so it'd be about $3,000. That's the quick way to do it. Now, the precision way to do it is to log into your account on our website. So you can go to acera.org/WMS or go to acera.org and click on the login button. And what you're going to do when you get in there is use our Benefit Estimator, online Benefit Estimator tool. And you're going to need 2 dates to use the estimator tool: separation date and a projected retirement date. Your separation date is your last day of work, your last day on payroll with your employer. Your projected retirement date is your first day of retirement. Often, these are 2 consecutive days. But if that's not your scenario, then your separation date is whatever it's going to be, and then maybe your projected retirement date is much later. Okay, you get those 2 dates. You think of some retirement scenario. I'm going to retire 3 years from now. If you don't have an exact date, you just think I'm going to retire 3 years from now or 5 years from now or whatever it is. And you just kind of think of a date combination that lines up with that you want to try. And you go out to our website, you press the login button. I'll show you some screenshots here. And the first thing you're going to see is this account summary page, which has a lot of the your account data that we have on file for you. If you've never logged in here before, you got to create a login, but once you log in, you'll find your data is waiting there for you. And then you're going to click this Estimate a Benefit link, and it's going to take you to the Benefit Estimator. And this is where you plug in those dates. Okay, so I'll just zoom in on this estimator. You plug in your separation date, your projected retirement date in this scenario that you want an estimate for, and you hit calculate. And then it will project the amount of service credit you will have earned in this scenario. And it will also give you a salary projection based on your current salary. Okay, you have the opportunity to override both of those numbers if you want to. If you want a nice conservative estimate, then you just leave those blank. And also there's this add hours of cash vacation compensation. So you could find out what the impact of selling or cashing out vacation is by adding hours of cash vacation compensation there. And I'll explain how to do that in a minute, but for now you can just leave it blank. And you can fill out beneficiary information here if you want, and you hit get estimate, and you end up with this retirement benefit estimate PDF, where you have kind of the demographic data up here that it's using to calculate the estimate, and the estimate's down here. Okay, now I'll zoom in on this in just a second. Before I do that, let me show you how to use that hours of cash vacation compensation field to see what the impact of selling and cashing out vacation is on your benefit estimate. Let me show you how to do that without overestimating. Okay, so the whole goal of this area of your retirement worksheet is to help you do that without overestimating. And the reason that you might overestimate is because you already sold vacation during the time period the calculator is using to make that salary projection. And so what we're going to do is we're going to subtract out any vacation that you sold using this part of the worksheet. So what you do is you take your limit from the other area in the worksheet and you put it in here, your limit in weeks. Okay. So in this example, this person's limit is we are allowed to include 6 weeks worth of vacation pay in their salary calculation. Okay, now you want to put in your weekly work hours. Some of you work 40 hours, some of you work 37.5 hours. Put that in here and you multiply them together. And that gives you your limit in hours, your total limit. Now, for the AHS people, the AHS employees, we already knew your limit in hours. So you can just start here, put your limit in hours. Okay, now we are going to subtract out any vacation you already sold that was in that first retirement estimate. So if you can see, step one is run that estimate, leave the hours of cash vacation compensation field blank. So we already did that. So we're going to go back to that estimate and we're going to look at the spot right here, average salary date range. This is basically what it's telling you it's using as your final compensation period for calculating this estimate. So you think about this date range and you think, did I sell any vacation during this date range? If I sold vacation during that date range, how much did I sell? And you put that in hours here. So in this example, let's say I sold 40 hours. I sold 1 week's worth of vacation. Now I'm going to subtract that out from my limit. And then that gives me 200. And so the goal of this is to figure out if I want to get an estimate where I'm maxing out how much hours of cash vacation compensation. I just want to see like what the effect of getting my limit of vacation compensation in my salary calculation is going to be. I can do this calculation without overestimating. And so you would put that number in here. Now, if you didn't sell any vacation, then you could just put your limit in 240, okay, in this example. But you put that in here, you hit get estimate, and now you're going to see an estimate with the vacation added. So it's going to be bigger. Okay, now just to zoom in here, and it will say how many hours that you've added, and this number will be bigger. Okay, just to give you a few more details about this estimate, what you're looking at are these numbers. This is your estimate for each one of the different retirement options. Okay, I'm not going to go into detail about the options right this second, but I will in just a little bit later after we cover a few more topics. For right now, you can just look at the unmodified option because that's the biggest one that pays you the most retirement allowance of any of the options. And if you want to, you could go ahead and put that into your worksheet just so you can, kind of get a record of what the precision estimator told you on this day. And you can, fill out the other stuff here. Okay, so that is how to do a precision retirement estimate using our benefit estimator. You do have a third option, which is we will do the estimate for you. And you can submit a request for us to do that for you out on our website at acera.org/forms is one way to do it, or you can log into your account on our website and there's a form in there, an electronic form in there where you can do that request. One thing I'll tell you about this though is that one of our staff members is going to do this estimate for you, but they're going to use the same software and the same math as Web Member Services, which is our online benefit estimator, an online portal for you. And so they're going to get the same result. And so if you want a precision estimate that is quick and available, 24/7, you can just use that online benefit estimator. It takes like 5 minutes to do. So we've talked about getting you a retirement estimate and how your retirement allowance is calculated. Let's move on to the next topic, which is helping you verify whether you're eligible to retire or not and helping you understand when you become eligible. We're talking about this milestone on the milestone chart right here, your retirement eligibility. So I'm going to talk about tiers 1, 2, and 3 first, and then I'll tell you about tier 4 in just a minute. So for tiers 1, 2, and 3, you have these 3 ways of becoming eligible to retire. Option number 1 is that you're over age 50, you have at least 5 years of service credit, and you have at least 10 years of total membership with Accera. So the 5 years service credit, 10 years membership thing, one way to think about it is if you're working straight through into retirement, you can just think about it as having 10 years of service credit and being over age 50, because you're going to need to, have that 10 total years of membership and you're planning on working during that entire period. But you don't have to. If you have at least 5 years of service credit, you could stop working and you just have to wait until it's 10 years has passed since your date of entry into Accera. And as long as you're over age 50, you can retire. Okay, your second option for becoming eligible to retire as a tier 1, 2, or 3 member is you have at least 30 years of service credit as a general member or 20 years of service credit as a safety member, and you can retire at any age, even if it's younger than age 50. Option 3 is that you can have any amount of service credit, even if it's less than 5 years, and you can retire at age 70. So if you have 4 years of service credit, you can retire at age 70. It's not going to be a huge retirement, but it could pay for a bunch of your bills, like your like your phone bill, electric bill, water bill in retirement. So that is definitely a good thing. Okay, now moving on to tier 4. You have 2 options to become eligible to retire. As a general member, under option number 1, you have to be at least age 52. And as a safety member, you have to be at least age 50. And you can retire with 5 years of service credit. And you don't need to do the 10 years of membership thing. It's just plain old 5 years of service credit. Your option number 2 is the same as the tiers 1, 2, and 3. You can retire with any amount of service credit at age 70, even if it's less than the 5 years. Okay, so that topic is quick. That's how you are eligible to retire. Once you're eligible to retire, you can choose any retirement date after that you like. Okay, so now that you know your retirement eligibility date, you can put that in here if you like. If you already know that you're eligible to retire, you don't have to worry about what the exact date is, but you could put in an approximate date if you like. Okay, next topic. Let me help you choose your retirement date. Okay, there's a question. How do we communicate the highest salary average to a Sarah when we request a formal estimate of retirement deferred member not using the online tools? Oh, I see, because you're a deferred member with reciprocity. I think they're probably just gonna, I actually don't know the answer to that question. I don't know if they request that from you. I would doubt it. I would think that they would just call up the other system and get an estimate from them. That's my guess. But we'll definitely figure that out for you, because we have tons of reciprocal members and we do that all the time. Okay, so let me help you choose your retirement date. We're talking about this date on the pension milestone chart. This is your retirement date. It's a date that you choose after you achieve retirement eligibility. Here are the things that you're going to want to think about when you're finding the best date to retire. Will you have enough income? We'll talk about each one of these: age factor percentage dates, cost of living adjustment, if there's a conflict between those two, and then I'll help you actually figure out what day to retire. So let me go into each one of these. The first one is, will you have enough income? So the way to figure this out, this is totally optional. I mean, you can, if you're kind of a fly by the seat of your pants person and you don't want to figure this out ahead of time, because it stresses you out, you don't have to. It is a good idea to kind of get a picture of what the future is going to hold. And so, so this is kind of how you do it. What you do is you get that Acera retirement estimate. So use our online calculator, get the estimate. It's also a good idea, if you have a deferred compensation account or any other investment accounts, to get an idea of what the balance is of those accounts. And then use the Social Security estimator on their website to get an estimate of what you can start receiving at age 62 and beyond. And then if you want to, this is kind of like extra credit, you can even think about your post-retirement expenses. But these first three that's going to be where your income is going to come from after retirement. And so what financial planners will say is that you're going to need at least 70 to 80% of your pre-retirement income to maintain your standard of living. So what's good about getting a picture of this ahead of time is to see if you're kind of achieving the 70 to 80% income replacement. And then this extra credit piece is really, you're looking at the numbers, you're looking at what my income is going to be versus what my expenses are going to be. So it's up to you, but it's a good idea. If you want more information about this, I think a good way to do it, we actually have a post about this on our site. If you go under members and you go to preparing to retire. Okay, and so this is all the steps that we're going to ask you to take while you're preparing to retire. And one of the things that you can do is go through these step by step. So this is a more detailed version of what I'm showing you on the slide, where it's actually helping you, walking you through it step by step, and takes you to all the calculators and stuff. And there's even the extra credit where you can calculate your expenses if you want to. Okay, so that's what I recommend. Go back to the presentation. So that's number one. Number two is thinking about these age factor percentage dates. So let's revisit this topic from the beginning of the presentation. If you recall from the beginning of the presentation, I showed you that every 3 months that you don't retire based on your birth date, you go up one notch in the age factor percentage chart, as long as you haven't yet reached the maximum age for your tier. Okay. So I think it's a good idea, if you have not yet reached the maximum age factor for your tier, to be cognizant of what these days are. So to give you an example, if your birthday is January 15th, 1 quarter after your birthday is April 15th, 2 quarters after your birthday is July 15th, and 3 quarters is October 15th. Okay. Now, if you're thinking about you're choosing your retirement date and you're thinking, let me see, I'm going to retire on July 14th. Don't do that, because if you just wait 2 days, if you work on July 15th and retire on July 16th, you're going to get a slightly higher age factor percentage, and it's going to increase your retirement allowance by a little over 1% just by waiting 2 days. Okay, just by being cognizant of these dates. And the same goes for all of these other dates. Okay. So I'm not saying that you need to retire right after one of these dates. All I want you to do is be cognizant of what these dates are, and don't retire right before one. Okay. Just if you're going to retire midway between the two, that's fine, because you don't want to work at there's 3 months in between these, and that's working an extra 6 weeks. And so if you're done, you're done. But all I'm saying is don't retire right before one, when if you knew what the date was and you just worked another week or whatever it is, and you retire after that date, you get a 1% bump in your retirement allowance. Okay. Third topic, cost of living adjustment. Let me explain how this works. The cost of living adjustment, also known as COLA, is an annual increase to your retirement allowance. It's a percentage increase. And the percent increase that it's going to be is based on how much prices go up in the San Francisco Bay Area from December to December. This is measured by a measurement called the Consumer Price Index, which the Department of Labor calculates. And so what we do, everyone who is in retired status on April 1st every year gets the cost of living adjustment. So if you've already been retired for some years, you're just every year when April 1st comes around, you just get that cost of living increase. It's one of the vested benefits. If it's your first year of retirement, okay, you're about to retire. If you retire on or before April 1st, you'll get the cost of living adjustment for that year. If you retire on April 2nd or after, you'll have to wait for next year's cost of living adjustment, because you will have already missed the cutoff for this year's cost of living adjustment. Okay, so that's why a lot of people end up retiring in March, because they're already ready to retire. And they're like, well, if I retire now, I'm going to get this nice increase immediately to my retirement allowance. Whereas if I, miss it, then it's going to take a little while for me to catch back up. Okay, so there is a maximum limit to the cost of living increase, and the percentage is whatever the CPI increase is. So like if prices go up 5% in the Bay Area from December to December, that becomes the number that we use for the cost of living adjustment, but we have to cap it at 3% for tiers 1 and 3 and 2% for tiers 2 and 4. But any percentages over that, we put that in your COLA bank and we save it for you in the future. If inflation is less than the cap in the future, let's say the next year comes around and inflation is 1%, then we'll take percentages out of your COLA bank and add it to that 1% to get you up to your max. The bottom line with this is that if you've already been retired for like 2, 3, 4 years, almost like everyone has percentages in their COLA bank. And so you tend to just get the max after a while, just every year, because of that COLA banking. Okay, let me see. I have a couple of questions here. Okay, so I do have a question, and so I do sometimes get asked this. Let me go back to the these cutoff dates. And so people will ask about this regarding, so this is regarding the sick leave conversion. So remember, we're going to convert your sick leave if you go straight into retirement on a 2-to-1 basis of service credit. And so you could get, another month, 2 months, 3 months worth of service credit. The question is kind of, it boils down to, does that push out my retirement date? No, it doesn't. Your retirement date is your retirement date. So whatever day that you retire is going to be the day that we're going to consider for whether you've crossed one of these age factor percentage dates or not, or whether you crossed the COLA date or not. Okay, now all the sick leave conversion does is it just increases the number that we put in the formula for you in regards to your years of service credit. That's the only thing it does. It doesn't move any dates around. Okay. Oh yeah, thank you for that question. That's another thing I didn't point out. So the question is, if you're over age 65, and I'm assuming you're probably in tier 2 because you're talking about age 65, which is when the tier 2 age factor maxes out. Do these age factor percentage dates increase? Percentages increase? No, they don't, because you already achieved the 2.43% maximum age factor percentage for tier 2 at age 65. So over the maximum age factor for your tier, whatever it is, you don't even have to think about these dates. Just totally forget about that whole concept, because it doesn't matter. You've already achieved the highest age factor percentage for your tier. So don't worry about that. Okay. And then there's a question. I thought that was for vacation. Can you maybe clarify that question? Okay, so now back to the cost of living adjustment. So I explained how the cost of living adjustment works. Now, sometimes people ask about if there's a conflict between the age factor percentage increase date and the cost of living adjustment. So to give you an example, let's stick with the January 15th birthday because it's easy to do. And it kind of creates the conflict based on where the birth date falls. And I'm specifying age 54 because that is, for all the general members, that is younger than the maximum age factor percentage for your tier. For the safety members, you've probably already reached the maximum age factor percentage. Okay, now you already know you're retiring in the spring, and you're thinking, my birthday is January 15th, so should I retire on April 16th? So I'll work April 15th, retire on April 16th, and in that scenario, I will get the age factor increase for having passed my quarter year birthday day, but I'll miss the cost of living adjustment because I would have had to retire, 3 weeks ago, about 2-3 weeks ago, on or before April 1st to get that. Or should I retire on or before April 1st and miss the age factor increase I'm going to get in a couple of weeks by passing April 15th, but I'll get the cost of living adjustment increase? Which do I choose? Well, you probably already know the answer because I told you the percentages. But if the cost of living adjustment is the maximum for that year, and it tends to be because inflation tends to be about 3%, we'll tell you what the cost of living adjustment is in early February every year on our website. So if the cost of living adjustment is the maximum, you're going to go with the cost of living adjustment because it will give you a 2% increase right now, or a 3% increase if you're in tiers 1 or 3 right now, versus the kind of a little bit over 1% increase you would get from just the age factor percentage increase alone. Now, I kind of get into the weeds on this. If you are not retiring in the spring, you don't even have to worry about this COLA date, because if you retire in September, for example, when April 1st comes around, you'll get the cost of living adjustment, or December or August, whatever. It's just that there's this period of time after April 1st where, yes, it might have been good for you to retire on or before April 1st, but it quickly resolves itself after a couple of months. I mean, this whole dilemma resolves itself after a couple of months, because after 3 months, you're going to pass another age factor increase day. So that's going to be another 1% increase. And then you're going to earn more service credit toward retirement. And so after a couple of months, you're actually going to have earned more retirement than had you retired before these days. So I think a good way to do it is just to go by what your retirement benefit estimate says. If you're going to retire in the spring, you can do like 2 estimates in this case, like April 1st and April 16th. And then the April 16th one, it is going to take into account the age factor increase. But for the April 1st one, you will have to, do the math to increase it by the cost of living adjustment, but you can kind of see what the dollar difference is in yourself. So just like the rest of the year, don't worry about the cost of living adjustment. Just think about those age factor increase days. And like I said, don't sweat it too much. Just don't retire right before one. Okay. Let's see, I have a few questions up here. Okay. And feel free to ask questions, hang around and ask questions afterward, and we can clarify anything. Okay, and there's one more question. Workers' comp time used during service is not included in years of service credit. Is this true? So if you go out on workers' comp, that is one of those leave times that is purchasable. And so I think sometimes what happens is you're out on workers' comp leave, and it's like you have a pay period where you're partially being paid by the workers' compensation system, and then you're receiving a partial paycheck from your employer. For whatever part of that pay period you're getting a check from your employer, you're earning service credit, like a portion of the service credit you would have earned. But for the workers' comp time, you're not earning service credit for that time. But when you're back from that workers' comp leave, you can purchase that time to get that service credit back. But yeah, you do not earn service credit for that time while you're in the workers' comp time, while you're out on the workers' comp leave. But then when you return from that leave, that becomes purchasable, and you can purchase that time as service credit. Sure. Okay. And is that true of safety members also? Yes, that is true of safety members also. Okay, okay, and then there's a question, how do I find out if I have any purchasable service credit? Well, I suggest going to our service credit page, acera.org/purchase. And there's like a more detailed list there of the types of time that are eligible for you to purchase. And all of the categories are kind of things that it's like there's this time period where you could have, if the situation was a little bit different, you could have earned service credit during that time. But since the situation was what it was, you didn't earn it. But now that you're back working, you can purchase that service credit. It's kind of like a high-level summary of the types of time that are eligible for you to purchase. So I would just go through the list and think about if you have any of those types of time. And if you have any questions about any of those individual types of time, whether it's eligible or not, then you can go ahead and fill out a purchase request form, which is on our forms page. And we will write you a letter and tell you whether the time is purchasable that you're asking about, and how much it's going to cost. Okay, there's a question about the retirement options. I'll go through that later. And then somebody's saying, I was told that workers' comp counts towards service time, but temporary disability does not. I learned this when I requested an audit. Okay, that could be true. I could be giving out incorrect information. So one of the ways that you could look at that is if you look at your old pay stubs, like if you look at your old payroll records, you can see how much credit you earned for each period. And if you earned the full amount of service credit for each one of those periods, then you didn't lose any service credit. And so you wouldn't have to worry about purchasing it. So that's one way to do it. But if you do have questions about that, again, whether like if you have workers' comp time, you can call into our call center, which is 510-628-3000, and ask about that. Or you can go ahead and fill out that purchase request form. And so then there's a question, either way, the estimator correctly shows your service time correct. So yeah, that's another way to verify it is if you go into your web member services account, like your account on our website, there is on the summary screen, there is a calculation of how much service credit you've already earned. And it can be about 2 to 4 weeks off because of the speed that the records go into it. But if you kind of calculate how much time you've worked and it matches up exactly, then you haven't lost any time. If there's time missing, then that's when you might want to contact us to figure out like where that time is. Okay, so the last thing that you're going to want to consider when you are choosing your retirement date is, or the last thing that I'll tell you about choosing your retirement date is how to actually like choose it when it comes right down to it. So first of all, if your goal is to go straight into retirement so that you don't spend any time as a deferred member, which means that we will do the sick leave conversion for you to service credit, then what you want to do is you want to retire on the next day after your last day in active pay status. So this day right here in this example is a Friday. And that means that your retirement day would be the next day on Saturday. Okay. So this is your last day on payroll. You can be on leave that day. You can be on sick leave. You can be on vacation leave. That's fine. You can be on a floating holiday, whatever. But you are on payroll that day. And then the next day is your first day of retirement, the first day that you are not on payroll. That means there's no gap between these two. And that means that you've gone straight into retirement. And we will convert your sick leave to service credit. Another way to think about it is this day, in this example, it's the 24th of Friday, is the day that you write on your letter of resignation to your employer. This day, Saturday the 25th, is the day that you write on your retirement application to ACERA that your first day of retirement is. So that's how you do that. We even have an example of a letter of resignation that you can copy on our website to help you, make sure that you do this date thing correctly. Okay, now this last topic is related and similar, but it's just kind of more detail about this. This day that you want to pick as your retirement date should not be a holiday, okay? And I don't remember why, but they explained it to me one time and I forgot. But your retirement day should be a non-holiday day. And it should also be a day where you are regularly scheduled or where you are scheduled to work the day before, okay? So for example, you regularly work Monday through Friday. So you don't want to retire on Sunday or Monday because you don't regularly work on Saturday or Sunday. Okay, so let me go back to the calendar. If you work Monday through Friday, your first day of retirement can be Tuesday, Wednesday, Thursday, Friday, Saturday, because you are scheduled to work the day before that. Okay. Now, for those of you who have a, not a regular schedule, like some of our safety officers and some of our healthcare workers, you might work, schedules all around the clock, and it might not be a regular schedule. And thank you so much for doing that. It's amazing what you all do. So what you're going to want to do is maybe you don't pick an exact day way ahead of time. You wait until closer to the time when you see what the schedule is going to be. And let's say you get closer to the time and you see that the schedule is going to be you're working Monday through Wednesday. Okay, now you know how to pick a day after you're scheduled to work. Okay, so that's how that works. Okay, so now that you have a better idea of how to figure out what day you might want to retire, you can put that into the worksheet if you changed your mind or if you, learned something that helped you pick a retirement date, or you could do this later. And now that you know that if you're going straight into retirement, your separation day should be the day before, you can simply just write the day before on your worksheet. Okay, now let's talk about the next topic, which is the application process. How do you actually retire and apply to retire? Here's how this works. Step one is you go through our preparing to retire section. I showed you that a few minutes ago. It's kind of like a step-by-step section of everything we want you to know and do about preparing for your retirement. It has things like, making sure we have certain documents on file, changing your online portal username to your personal email account, resigning, putting in your resignation letter, so on and so forth. Step two, you are going to set up a ready to retire counseling session. And you do that on our website. You submit this form, Accrue.org. It's at Accrue.org/counseling. And it's funny, it says, submit form before retirement date to fully prepare. What it should say is submit that form within these 3 to 6 months before your retirement date to fully prepare. So that must have got deleted somehow. So in the 3 to 6 month period before your retirement date is when we suggest filling out this form to go ahead and notify us that you are getting ready to retire, because that gets a lot of wheels in motion that we have to do in terms of preparing for your retirement calculation. Okay, then step three is submitting your retirement application. So within the 90 days before your retirement date, you submit your retirement application, and there's an entire page on our site that takes you step by step through submitting the application, and it's at Accrue.org/retire. And it is one of the pages at Accrue.org/prepare. Okay. Now, when you set up the Ready to Retire counseling session, what somebody's going to do is contact you, and they're going to schedule that session for that 90-day period before your retirement date. And also during the counseling session, they will help you submit your retirement application. Okay. So they'll kind of plan that with you ahead of time. They'll be in contact with you. There's also this step 4 option election agreement where you're going to select one of 5 retirement options. And so the current process is that you receive this 2 weeks before your counseling session, and you can also submit that at the counseling session. Now, this process is going to change pretty soon, where the options are going to be part of the retirement application, so you're going to do it all at once. And then you submit your retirement application, we process it, and once the day passes that you wrote on your retirement application, you're retired. Woohoo! Amazing. You're going to be retired. It's coming up soon. It's going to be awesome. So that's the process. Now, I have a question here. Okay, so this is regarding the 415B limit. So this was one of the limits on the page talking about the limits to your retirement allowance. So I think, there's a employer paid benefit replacement, and I think it just, any part of your retirement allowance that gets clipped by the 415B limit, the replacement plan kicks in and pays what your retirement allowance would have been. So I'm actually not super clear on how that works. My suggestion for information on that would be to go ahead and contact us. Go ahead and give us a call, or you can email us at Accrue.org/contact. And our phone number is 510-628-3000. Yeah, sorry, I'm not well versed in that. And what WMS is Web Member Services. So Web Member Services is is that online portal that we have. It's basically your online account. And so changing your username for that account to your personal email address is important to do prior to retirement. But if you go to acera.org/prepare, there's more details about that on there. Okay, there's a question. What happens if you want to or need to retire within just a few weeks or even a few days? You can do it. You can absolutely do it. This whole, lengthy process is kind of the ideal scenario, but, we get people all the time that decide to retire at the last minute, or not even decide. It's just, kind of something they have to do. So yeah, we can help you through that. So what I would suggest is go ahead and submit this counseling form. And if it really is like that quickly, you might want to just go ahead and give us a call as well after you submit the counseling form, just to make sure that, you talk to somebody immediately. Okay, and then, okay, so the time frame for setting up a counseling session is 3 to 6 months prior to your retirement. So you have like 6 months prior to your retirement. In the 3 to 6 months, you set up the counseling session, and the 1 to 3 months is when you're going to actually have the session. So yeah, sorry, I didn't include that on the slide. Does it matter if you retire mid-pay period or the first pay period in the month? It does not matter. Okay, so now that you know what the date is to call in for the Ready to Retire counseling session, and I'm sorry, it should say, I need to redo the screenshot. It should say fill out the form. Then it's 3 to 6 months. You can just subtract 6 months from your retirement date and go ahead and put that date in here. You can expect your first retirement check within 4 to 6 weeks after your last employer paycheck. So in almost all cases, what's going to happen is you're going to get that check, and it's going to be a 100% payment of your full retirement allowance, your final calculation. Except if there's any major issues with your file, then we're going to start paying you within that 4 to 6 week period after your last employer paycheck, but we're going to be giving you 80% payments until we resolve these issues. Okay, but you'll also receive retro payments later, so that you get your full retirement amount for any retro payments or for any 80% payments that we made. Okay, so your first retirement check is 4 to 6 weeks after your last employer paycheck, and you're going to get paid on the last business day of every month for the rest of your life. And it's going to be direct deposit. The first check, I think, is paper, but everything after that is direct deposit. Okay, now we have reached the part of the webinar where I tell you what the 5 retirement options are and what the details are of each one. There are 5 options. There's the unmodified option, and there's options 1, 2, 3, and 4. Oh yeah, let me answer this question real fast. If you do take that annuity, yeah, you can go work anywhere other than one of Acera's agencies. We don't care where you work. And so we're just going to consider you an Acera retiree, and you can go do whatever you want. So yeah. Yeah, you're gonna receive your retirement allowance every month for the rest of your life. And it's actually like that applies to everyone. Once you retire from Acera, you can go work somewhere else if you want, and we're just going to consider you an Acera retiree, and you just get your retirement allowance every month for the rest of your life. Okay, and there was an earlier question about option 1. Okay, and so we're going to cover that right now under these the explanation of these 5 options. So at the time of retirement, on that option election agreement currently, but pretty soon on your retirement allowance, your retirement application, you're going to choose one of these options. This is your only point at the time of retirement. This is your only time that you get to choose one of these options, and you can't change it later. Okay, so it's good to understand what they are, because you're not going to be able to change it later. For each one of the options, I'm going to tell you about what you're going to get as a retiree. That's going to be in this top row here, retirement allowance. And then the bottom rows or rows is going to talk about what your beneficiaries are going to receive after you pass away. So a beneficiary, just to define that word, is somebody who gets benefits. Your ACERA beneficiary is somebody who gets your ACERA death benefits after you die. Okay, so it's somebody that you name. The first option is the unmodified option. This pays the maximum retirement allowance of any of the other options. That's why most people pick this one. It pays the highest retirement allowance. Now, after you die, this is going to pay 60%, a 60% continuance to your beneficiary. So if you remember, a continuance is just a continuing payment. So that means you're getting your monthly payment as a retiree. And then after you die, your beneficiary is going to get a continuing payment every month. Okay. If your beneficiary is your spouse or state registered domestic partner who you have married or registered at least 1 year before retirement, then it's going to be a lifetime continuance. So whatever your retirement allowance was, they're going to get 60% of your retirement allowance every month for the rest of their life. And if you have a service-connected disability retirement, it's 100%. Now, if you don't have a spouse or state registered domestic partner, but you do have minor children at the time of retirement that you want to name as continuance beneficiaries, one minor child or multiple minor children, you can. They will also get a monthly continuance after you die, and it will also be 60%, but it's not going to be for a lifetime. It's going to stop at age 18, or it can continue until age 22, as long as they maintain enrollment as a full-time student in an accredited school. And then it'll cut off at 22. But it will also cut off if they get married or they register a state domestic partner during that time. It will stop. Okay. Now then, there's this part here, lump sum payment. If you don't have a spouse or state registered domestic partner or minor children at the time of retirement, but you still want to name a beneficiary, you can name somebody not for a continuance, but for a one-time lump sum payment. And your beneficiary can be anyone. And the lump sum payment is going to be basically whenever you die, we're going to refund to them the balance of your contribution account. So what's in your contribution account is all of your employee contributions that you paid throughout your entire career, plus all the interest that we have posted to that contribution account, minus all of the retirement allowance payments we've already paid out to you while you were a retiree. One thing that I will tell you about this is that if you die after the first 3 to 5 years, there will not be a balance left in your account, okay? Because the balance is exhausted within the first 3 to 5 years. So anyone you named for a lump sum payment will only get some like small payments here and there, like the $1,000 lump sum death benefit, like a partial month's payment because you died like halfway through the month, a refund of any healthcare premiums you paid early. So there will be some little amounts, but there's not going to be a big lump sum in there. That's the bad news. The good news is that means that in retirement, everything you paid into the retirement system throughout your entire career, you're going to get all that back within the first 3 to 5 years of retirement. And then everything after that, all of the retirement payments you receive after that for the month of every month for the rest of your life is just like a bonus. And the bonus that you get is because you are participating in a defined benefit pension plan that guarantees you a lifetime retirement allowance. The whole point of the defined benefit pension plan is that you're getting a retirement allowance you can count on for the rest of your life. So you can make your retirement plans based on this guaranteed amount that you're going to get for the rest of your life. Okay. So that's kind of an aside to this unmodified option. Okay, now there is a question, can you change your beneficiary anytime after retirement? This is a good time to answer that because yes, you can, but only for lump sum payments. The only time you can name a beneficiary for a continuance is at the time of retirement. So for example, if you named your spouse at the time of retirement as your continuance beneficiary, but they die before you do, yes, you can name a new beneficiary, but only for lump sum payments, not for continuance. The continuance can only be named at the time of retirement, and it can't be changed. So if you retire and then you get married after retirement, you can name your new spouse as your beneficiary, but only for lump sum payments, not for a continuance. Okay, I think that's all I wanted to say about the unmodified option. Option number 1 is called lump sum to beneficiary. It's kind of the subtitle because this doesn't pay a continuance. This is the only one of these options that does not pay a continuance to anyone at any time. This pays slightly less than the unmodified option. And I think when you do the retirement estimate, you'll find that it's only a little bit less. What it does do is it leaves a larger lump sum in your contribution account for a longer period of time. So rather than the balance being exhausted in the first 3 to 5 years of retirement, it takes 10 to 12 years to exhaust that balance because the accounting is a little bit different in that in order to make this lump sum benefit a bigger benefit because it's not paying a continuance to anyone. So that's what that does. The beneficiary can be anyone for the lump sum benefit. Okay, option number 2, this pays all the rest of the options, 2, 3, and 4, they pay continuances to beneficiaries. Okay, what option 2 does is it does a couple of things. Rather than paying a 60% continuance to a beneficiary, it pays 100% continuance to a beneficiary. So whatever you're getting paid as a retiree, your beneficiary is going to get a continuance every month for the rest of their life of that exact same amount plus cost of living increases. Okay. The second thing it does is it expands the group of people that you can name as a beneficiary for a continuance to anyone. You can name anyone as a continuance beneficiary. Not just spouse or state registered domestic partner. But if you do have a spouse or state registered domestic partner, their rights to that continuance supersede anyone you designate as a beneficiary. Okay, just as some fine print there. One thing to note is this pays less than the unmodified option. And the amount less that it pays is based on your beneficiary's life expectancy. So if you name somebody who is significantly younger than you do, there can be a sharp benefit reduction to you as a retiree. And that's all calculated at the beginning of your retirement. So you're going to be naming the continuous beneficiary. We calculate your retirement based on their life expectancy. And so whatever your retirement allowance is at that point, that's going to be it for the rest of your life, even if your beneficiary dies before you do. We don't recalculate your retirement allowance. Okay. And let me think. There was one more thing I wanted to point out about that. The reason that the reduction is based on the beneficiary's life expectancy is because if the beneficiary is a lot younger than you do, we're assuming we're going to have to pay the beneficiary more, so we're going to pay you less, versus somebody who's older. We're going to assume based on their life expectancy that we're going to pay them less, so your retirement allowance isn't going to be as reduced. Now, option 3, moving to the next option, is the exact same thing as option 2. The only difference is that it pays, rather than 100% to your beneficiary, it pays 50%. So whatever your retirement allowance is at the time of your death, your beneficiary is going to get half of that every month for the rest of their life. And all the same rules and caveats apply to option 3 as option 2. Okay, now the final option, option 4, this is the one where you have a lot more choices. Okay, all of the other options, if you want to leave somebody a lifetime continuance, you can only name one beneficiary. For this one, you can name multiple people for a lifetime continuance, and you can specify the dollar amount that you want to leave them starting off, or the percentage of your retirement allowance amount that you want to leave them. And you can divide it differently between different beneficiaries, or you could name one beneficiary for a certain percentage. So for example, you have 2 adult children. You can't name them for a lifetime continuance under the unmodified option because they're not minor children. You can't name them both for a lifetime continuance under options 2 and 3 because there's 2 of them. Okay. You can name them both for lifetime continuance under option 4. And you could specify they each get 50-50, or you could give them both 30% and 30%. And so combined, they're only getting 60% of what your retirement allowance was. Or you could do it even less. Or if you only had, let's say you have one adult child, you could just, but you want to leave them a little bit of continuance, you could give them that one child, adult child, a 30% continuance. So you have some choices there. And the reason that you might want to do it less is because, again, if we expect to pay the beneficiary more, we're going to pay you less. And so the reduction from what the unmodified option is going to be based on the life expectancy of your youngest beneficiary that you name, but also the amount that you are specifying that you're going to be leaving them. Okay. So those are the 5 options. Now, that's sort of the abstract version of what these options leave behind to your beneficiaries. If you want to get exact estimates, there's an easy way to do it. You go back to the benefit estimator, you do your retirement scenario, you fill out this beneficiary information area. If you have already designated your ACERA beneficiaries, and hopefully we have beneficiaries on file for you, then you may find them in the dropdown and you can select them. If you do that, check the date of birth, because some of the dates of birth are wrong, and that will throw off the calculations. Otherwise, you can just type your beneficiary info in there. You hit get estimate, and I'll zoom in here. So now these options might make a little more sense to you. So again, these are the allowance options for these allowance estimates for each one of the options, the unmodified option, options 1, 2, and 3. And then the beneficiary allowance it's an estimate of what your beneficiary would receive after you pass away. This doesn't give you an estimate for option 4 because there's too many different variables for us to put into the calculator. So if you want an estimate for option 4, you can submit a retirement estimate request and we'll do that for you. And there's 2 more numbers here I want to point out. If you are interested in option 1, which is the one that leaves a lump sum to a beneficiary, it gives you 2 more numbers here to kind of plan out your retirement, which is the balance of your contribution account and that would be paid out to your lump sum beneficiary, and then the monthly annuity payment that is going to get subtracted from that every month of your retirement. And so if you want to see how long that there's going to be a balance in the contribution account to pay to a lump sum beneficiary, all you do is divide the big number by the little number, and that will tell you how many months it's going to last. And then you can even divide by 12 and it'll tell you how many years it's going to last. So that's how that works. Can the beneficiary be a trust account is one of the questions. The beneficiary can be a trust account only for lump sum benefits, not for continuances, because a trust has no lifetime. So we need to we could keep. Let me just summarize it by saying a trust has no lifetime, and so you have to have a lifetime in order to be able to have a continuance, is kind of the bottom line there. And then there's a question, what if I never added my husband as beneficiary when we got married and we have been married for 23 years? So I believe that if you were to die before you retire, there's a whole set of active death benefits, and you can find those on our webpage at acera.org/death. If you are talking about dying after you retire, but you didn't name your husband as a continuance beneficiary, I'm not exactly sure what would happen. It is, I think, probably he would still get the continuance because it's, I think that would probably happen, but you would want to check with our staff to clarify. But I mean, if you're doing it I mean, if you're already filling out the retirement application, you might as well write him in there. But it is one of the things that, if you should die before you retire, one of the things that having a beneficiary designation form on file with us does is it makes it so that we can efficiently pay out your beneficiary. If not, then we have to go through a whole next of kin process, and it can be a big hassle for the person that you're leaving behind. And so it's a really good idea to just go ahead and designate your beneficiary. You can log into your account on our website to see who you have currently designated as your beneficiary. And if you look in there and there's no beneficiary designated, or it's or if that beneficiary is wrong, then you can go ahead and redesignate your beneficiary. And it's actually super easy. You just go to acera.org/forms, and there's a form on that page called the Active Deferred Beneficiary Designation Form. And all you need to do is fill out the form, sign it, and then you can either take a smartphone photo of it and email it to us at info@acera.org. Or I think the best way to do it is use the Adobe Scan app, which is a free app on your smartphone. And it makes a much nicer, it still uses your smartphone's camera, but it makes a much nicer document. It kind of makes your phone into a scanner. And then you can send it electronically that way to us. And actually, I just said that you could email to us, but actually the most secure way to send in any forms or documents to us is we have a file uploader in your account. If you log into your account, there's a secure file uploader, because if you're filling out a beneficiary form, there's going to be a social security number on it, and email is not the most secure thing in the world. It's not very secure at all. People break into email accounts all the time. So I recommend using the file uploader inside your account. But I don't think the form takes that much time to fill out, and it's a good idea to go ahead and, just keep your beneficiaries up to date. And the way that you designate the continuance beneficiary for the options is you do that on your retirement application. So you'll see that when you fill out the forms. Okay, so let's see, we have a half hour left. This part about understanding other benefits sometimes takes maybe 40 minutes. So we might go a little bit over, and we might cut into Jean's time a little bit, but so I just wanted to give you a heads up about that ahead of time. Okay, so let's talk about other benefits. What we've been talking about up to now are the guaranteed benefits, the lifetime retirement allowance, the cost of living adjustment, death benefits. There's also this group of non-guaranteed benefits, also known as non-vested benefits, that you may also be eligible to receive in retirement. The reason they're not guaranteed is because they're kind of extra benefits. They're kind of like bonus benefits that weren't part of the pension law that created all the pension systems in the state, all the county pension systems. But it's something that the county decided that the retirees needed to have to pay for their lives sometime in the 80s, and they started this reserve fund to pay for these benefits. And so that right now there's about $930 million in that reserve fund to pay for these benefits. And what our Board of Retirement does is they just kind of keep track of this reserve fund annually. They're the ones that are in charge of ensuring the sustainability of this fund. And so they might change what the benefits are, reduce benefits, eliminate benefits, change rules around benefits in order to maintain that fund sustainability, because the whole goal is to continue offering these types of benefits to retirees now and into the future. So that's just kind of a aside about the fact that these are non-guaranteed benefits. I will say that this fund, there's a massive amount of money, almost $1 billion in this fund, and so as a result, we provide a higher level of these healthcare benefits than any county in California. So here are the current rules that the board has set up. Okay, there's 5 benefits here. There is a medical subsidy known as the monthly medical allowance. There's a dental subsidy, a vision subsidy. These all help pay for the cost of being enrolled in our healthcare plans. There's also a Medicare subsidy, that helps you pay for the cost of being enrolled in Medicare, which is the federal government's healthcare system, healthcare payment system. And then there's a supplemental cost of living adjustment, which is in addition to the vested cost of living adjustment. Now you can see that in this chart, the qualifications that the board has set up is that you need a certain amount of ACERA service credit years to qualify, years of ACERA service credit. So this reciprocal years of service credit does not count here. Okay, this is years of ACERA service credit only. The only benefit here that doesn't require any years of service credit to qualify is the supplemental cost of living adjustment. All the other ones start at 10 years of ACERA service credit. And then the monthly medical allowance actually has 3 levels of subsidy. And it starts at 10 years, you get half of the monthly medical allowance. At 15 years, you get 3/4 of the monthly medical allowance. And at 20 years, you get the full monthly medical allowance. Let me talk about each benefit and talk about our healthcare plans. We'll talk about the medical plans and the monthly medical allowance first. So first of all, again, this monthly medical allowance is not guaranteed. It only offsets the cost of ACERA-sponsored plans. So if you go out and get your own healthcare insurance, that's great, but you can't use the monthly medical allowance to pay for it. Now, we do offer inside ACERA, we do offer the ability to enroll in group plans and individual plans. And the monthly medical allowance for the group plans covers premiums, and for the individual plans, it covers premiums, copays, and deductibles. And premiums, the premium is just the monthly cost of being enrolled in the healthcare plan. The monthly medical allowance amount is set annually by the Board of Retirement. Any costs exceeding the amount of the subsidy, amount of the monthly medical allowance, you are responsible for paying. And it's not available for your beneficiaries, survivors, former spouses, dependents, anyone else except you. You can enroll them in the coverage, though. Excuse me. So these are the amounts for 2021. At the 10 years of ACERA service credit level, the monthly medical allowance is $289.33. If you have at least 15 years of ACERA service credit, it's $433.99. And if you have at least 20 years of ACERA service credit, the monthly medical allowance amount is $578.65. Okay, now these will go up a little bit next year for 2022. Okay, so somebody just asked, what are the plans? Here they are. So there's also a deferred member question. If my current employer covers me fully for the medical benefits, what happens with medical benefits with ACERA? Do I have options for use? I mean, if you're eligible for the subsidies and you want to enroll in the plans, I'm not sure if you can be double covered in 2 different plans. That would be a good question for our healthcare unit. So I would recommend calling in or writing into us at acera.org/contact and asking that question of our healthcare unit. You can just, ask the question and they'll send it to the healthcare unit. Sorry, I don't know the answer to that. If you don't want to take ACERA coverage, you do have the option of switching back later to ACERA coverage if you find that ACERA coverage later is better than whatever you were having with your other employer. And your annual opportunity to do that is in November. That's our open enrollment every year. Okay, now here are the plans. There's 2 sort of groups of plans here, or categories. There's non-Medicare eligible plans, which is if you are under the age of 65 and you're not yet Medicare eligible, then you would be looking at these plans here. Okay, Kaiser Permanente, United Healthcare, or an individual plan through VA benefits. Now, if you're Medicare eligible, then you would be looking at these ones here, the Kaiser Permanente Senior Advantage Plan or a VA benefits individual plan. Okay, so let me tell you, here's the order that I'm going to do it in. I'll talk about the group plans first. So the Kaiser Permanente and the 2 United Healthcare plans, non-Medicare plans. Then I'll talk about the Kaiser Medicare plan because it's easier for me to talk about the individual plans all together. Okay. through via benefits. So I'm just going to tell you what the costs are and just, some very basic details. If you want all the full details, we always publish this retiree enrollment guide every year, and you can find a PDF of that by going to acera.org/guide. Here are the non-Medicare group plans and their costs. So we have 3 plans. We have the Kaiser Permanente HMO, and then 2 United Healthcare HMOs, the Signature Value and the Signature Value Advantage. And you can see what the self-premiums are here. You can see that the Signature Value Advantage from United Healthcare is the cheapest plan, $759.16 per month. Kaiser is the second cheapest, $810.72. And then the United Healthcare Signature Value HMO is pretty expensive, $1,100 plus. For this, and if you already know about these plans, these are the same plans the county has. So it's all the same details. For the Signature Value Advantage plan, all you need to do is stick to this high performing network. So it's like this narrow network of high performing providers, and that gets you a 34% discount over the other United Healthcare plan. So it's a pretty good deal. And then you can enroll self plus one in family. Okay. Now, these are your self premiums. Let me tell you real quick about how the monthly medical allowance works in regards to how much it pays and how it pays and how it helps you pay for these plans. So here's a very crude illustration of your Acera check stub. This is your gross pay, $4,000 in this example. And then here's the deductions column and the additions column. Now, if you enroll in one of our group plans, we are going to, as a courtesy to you, deduct the premium, the monthly premium, which is the monthly cost of the plan, out of your check and send it over to the healthcare provider for you. So in this case, this person signed up for Kaiser. We're deducting $810.72. Now, if you're eligible for the monthly medical allowance, you will see in the additions column the monthly medical allowance amount that you're eligible for go back in. And so you end up paying the difference. And one thing you probably noticed about those plans is none of the plans are cheap enough for the 20-year, even the 20-year monthly medical allowance to cover the whole cost of the plan. So you do end up paying some. One thing that I'd like to mention here is all of these subsidies that we're talking about, these non-guaranteed benefit subsidies, none of them are taxable income. We have it worked out with the IRS where none of this is considered taxable income. So you don't have to pay income taxes on this. Okay, now let me tell you about if you're Medicare eligible, which is 65 and older, so you're eligible to enroll in the federal government's Medicare system. You can just take the plain old Medicare system, but you also have the opportunity to get a higher level of coverage by enrolling in these Medicare plans that kind of work with Medicare but offer a higher level of coverage. And one of those is the Kaiser Permanente Senior Advantage Plan, which is our group plan option for Medicare eligible individuals. So you can see the monthly premium is way cheaper than the non-Medicare plans. So $382.21, which is because the federal government is paying a lot of the cost. Now, what I've done here is I've given you some additional numbers to work with. First of all, I've put the 20-year monthly medical allowance amount as a row in the table so you can kind of see what the out-of-pocket cost would be to you. The other reason I did that is to illustrate this point, that the monthly medical allowance only pays up to the amount of the self-premium. Okay, so that is why the premium is $382.21, and if you have at least 20 years of service or even 15 years of service credit, your monthly medical allowance amount would be the same, $382.21. And so the cost to you would be $0 because you don't get to keep the change. The monthly medical allowance only pays up to the amount of the self-premium. And then there's some examples for different combinations of you having a spouse, or you having family, both of you are Medicare eligible, one of you is Medicare eligible, and which one you are, whether you're the Medicare eligible one or you're not the Medicare eligible one. Okay. Now, all of those group plans, you see it says must live in California service areas, must live in the California service areas. The service areas are San Francisco Bay Area, Sacramento, Fresno, and Southern California. And for Kaiser, I think they also have Santa Cruz. If you live in those service areas, you can enroll in the plan. It's based on zip code. If you're not in the service area, you cannot enroll in the group plan. So that is why we offer you the ability to enroll in an individual plan through Via Benefits. Via Benefits, first of all, let me say who can enroll in an individual plan before I say what Via Benefits is. So if you're not yet Medicare eligible, you must live in the US, but outside one of the group plan service areas that I just mentioned. So you could live in, up in Redding, and that's outside the group plan service area. You're in California, but you're not in the service area. So you would look for an individual plan option. If you are in the group plan service area, you cannot enroll in one of the individual plans. You have to pick one of the group plans. If you are Medicare eligible, in contrast, you can live anywhere in the US. Doesn't matter if you live in the Kaiser's group plan area, it's fine. Anywhere in the US, you can find an individual plan through Via Benefits, as long as you enroll in Medicare Parts A and B. Okay, what is Via Benefits? It is a company that acts as a marketplace. It's a private marketplace for helping you find healthcare coverage that's right for you. So they contract with 80 plus insurance carriers. And what they do is they have insurance carriers all over the US. And what they do is they help you find the plan that's right for you. So you call in by telephone, or you can do it online, search through plans. If you call in by telephone, you will deal with and talk to a certified, salaried, non-commissioned, non-biased benefit advisor. And I say all that because they're not getting a commission based on which company they put you with. They're just getting a salary. So they're going to narrow down the plan that's right for you. And when you call them, what you're telling them is where you live or where you're going to live, how much you want to spend, what level of coverage you want. You can even get down to what prescription drugs you need, what doctors you want to visit. They'll narrow all their plans down for you to just a few, and then you can choose among those. And for those individual plans, the monthly medical allowance will actually pay not only premiums, but deductibles and copays if you have a deductible plan, right? Probably every plan has copays. Now, the monthly medical allowance reimbursement works differently for the Via Benefits plans. We can't put it in your retirement check for various reasons. What we do is we work with the Via Benefits to help get you your monthly medical allowance. So here's yet another crude illustration of how something works at Acera. So here's Acera, and let's say that you're eligible for the monthly medical allowance. You have at least 10 years of Acera service credit, and you want to enroll in an individual plan through Via Benefits, whether you're Medicare eligible or not Medicare eligible. So what we will do at Acera is we will send your monthly medical allowance that you're eligible for over to Via Benefits. Okay. They are going to open what they call a health reimbursement account for you. So this money, this monthly medical allowance, is going to sit in your health reimbursement account over at Via Benefits waiting for you. Okay, now here's your bank account. You're going to enroll in healthcare insurance from an insurance company. The insurance company is going to charge you a premium amount every month for being enrolled in their plan. So you're going to have to pay them directly. Now you're out some money. Okay, now that you're in an insurance plan, you're going to go visit a doctor and you're going to pay the doctor a copay. Now you're out some more money. So what you do is you submit reimbursement claims back to Via Benefits, and they will pay you your monthly medical allowance amount to reimburse you for the amount of money that you're out. And they will help you set all this stuff to happen electronically, so you can have automatic recurring payments to your insurance company, recurring reimbursements for that to your account. And then the only thing that you would have to do individually is those individual copay reimbursements. But they will help you set all that up to do electronically as well. So that's how that works. Now, one more thing I want to say about the monthly medical allowance is if you are Medicare eligible, okay, you're Medicare eligible and you're going to get an individual plan through VA Benefits. You're interested in that. These plans are so inexpensive that the board decided to have a slightly lower monthly medical allowance amount for just the Medicare eligible people in the VA Benefits plans, which is shown here. Okay, so you can see that rather than 578, it's 443. But we do keep track of this, and we find that 90% of the people who are eligible for the 20-year monthly medical allowance don't run out of the money in the year. Okay, and then there's a question, do you have to choose only among the plans that VIA has? The answer to that is if you are looking for an individual plan and you want to receive ACERA subsidies for that individual plan, then yes, you have to choose among the VIA Benefits plans. You can't choose any outside plans. One thing that I'll mention is that there are some cases where if you have a lower income and you're going to live somewhere, or you live somewhere that has a robust state Obamacare market like California does, where the plans are pretty robust and they're not very expensive, and your income is low enough to give you a subsidy, a federal subsidy to help pay for the cost of that plan, that out of pocket might be lower than you signing up for a VIA Benefits plan and getting the monthly medical allowance. And VIA Benefits will actually do that calculation for you and help you figure that out. So you can ask them about that as well when you talk to them. There's a question, do you have to have Medicare if you're 65 and over? You don't have to, but if you think you will ever want to have Medicare when you're 65 and older, and you think you're going to sign up for it later, Medicare assesses a cost penalty to you if you sign up later. So the longer you wait to sign up for Medicare, the more expensive it gets. So, and if you have at least 10 years of ACERA service credit, signing up for Medicare Part B is not going to cost you anything. Okay. Okay, now, so we talked about the medical plans. Now let me talk about the dental plans briefly and the vision plans briefly, and then I'll talk about the Medicare subsidy. And let me just check this out here. Okay, so dental plans. There's a difference between the dental, there's two dental plans, Delta Dental PPO, Delta Care USA. Now there's a difference here if you have at least 10 years of ACERA service credit or not. If you do, then you have to enroll in one of the plans, but it doesn't cost you anything. The self-premium amount and the subsidy amount are the same, which is why the other slide said it pays 100% of your dental, because it does. I mean, 100% of the premium. I'm sure there's copays with it. If you don't have 10 years of ACERA service credit, then you can voluntarily enroll in the dental plan, but you're going to have to pay your whole way. There's no subsidy for that. Okay, and then you can enroll South Plus One and Family. Now, if you are going to get a subsidy, the cost of the South Plus One is simply going to be the South Plus One premium minus the subsidy amount. And that's what you end up paying. And this will go in and out of your ACERA check as well. Okay, the dental stuff. Delta Dental PPO is a nationwide plan, by the way. Now the vision works the same way as the dental. There's for the standard plan. So if you have at least 10 years of ACERA service credit, you have to be enrolled in the vision plan, but it doesn't cost you anything. It's the subsidy is the same amount as the self-premium. And you also have the option of buying up into a VSP premium plan, and you will pay the difference between the premium and the $397 subsidy. The subsidy doesn't go up if you buy into the premium plan. And again, the vision plan subsidies and premiums go in and out of your ACERA check. Okay. So also VSP is nationwide as well. Okay, now let's talk about the Medicare Part B reimbursement plan. We're done with that one. So once you turn 65 and you enroll in Medicare Part A, if you've worked at least 10 years in the Social Security system, then and like paid at least 10 years into Medicare, then Medicare Part A will be free for you. Okay. But Medicare Part B for everyone is going to have a cost. Now for those safety members, you can still enroll in Medicare. It's just that because if you didn't have a prior job where you paid at least 10 years into Medicare, then Medicare Part A is going to have a cost for you as well, but you can still enroll in Medicare. Okay. Now for Medicare Part B, Medicare Part B has a cost for everyone. And so in order to enroll in one of Acera's Medicare plans, you first have to enroll in Medicare. But because we mandate that you enroll in Medicare, and it's not really that we mandate it, it's just that the way the plans work. Like you have to enroll in Medicare first, and then you can get the plan that kind of sits on top of it. There's the subsidy that helps you pay for the cost of being enrolled in Medicare Part B. And so the cost that Medicare charges you for Part B is tiered based on your income. The tiers are pretty wide, so it takes a pretty good amount of income to get to the next tier. The base level, the base tier is $148.50. That's the cost, and that also happens to be the amount the board decided would be the premium. The reimbursement amount. So this is the subsidy amount that you would be eligible for should you enroll in the Medicare Part B reimbursement plan, which you should if you have at least 10 years of Acera service credit and you are enrolled in Medicare Part B. Because if you don't enroll in this, all you need to do is submit the enrollment form. You're going to be missing out on basically $150 every month. So you're going to pay the $148.50 directly to Medicare, and then you'll see the $148.50 show up in your Acera check. And then in order to qualify, you just need to have 10 years of Acera service credit, maintain enrollment in Medicare Part B, and then you just enroll one time in it, and you'll just get that payment, as long as you maintain your enrollment in Medicare. So there's a question here. It's my understanding that as long as we're employed full-time by Alameda County and getting group healthcare coverage, we do not have to apply for Medicare until we leave our employment coverage, correct? Correct. Absolutely. You do not need, and you should not enroll in Medicare prior to terminating your employment. And that penalty I mentioned before, where Medicare is going to charge you more if you enroll later after 65, that doesn't apply if you're still working. That only starts after you stop working and retire. Okay. And one more thing I'll say about Medicare is it's a big topic. We actually have a Medicare transition seminar that we offer 6 times a year. There's actually a recording of that out on our website, so you don't even have to enroll in it. You could just watch whatever the most recent one was. And you can find that in kind of the same menu that you found this seminar in. Okay, the last non-guaranteed benefit we'll talk about is the supplemental cost of living adjustment. This is actually a really powerful benefit. What this does is it maintains at least 85% of your original buying power in retirement at any time in your retirement. So if at any time in your retirement, inflation gets so bad, and it will eventually, because inflation is about 3% every year, so the cost of living increase, the vested one doesn't quite keep up with it. It tends to not quite keep up with it. Then when you lose 15% of your buying power that you enjoyed at the time of retirement, if you lose 15% of that at some time in your retirement, the supplemental cost of living adjustment kicks in and keeps you at 85% of your original buying power. And so it's really powerful. So you can't lose any more than 15% of your buying power in retirement to inflation. So it's a really, really powerful benefit. Okay, there's a question. If my husband is eligible for Medicare when I retire, when should I start his Medicare? So if my husband is eligible for Medicare when I retire, so my question is your husband still working? Because if he's not, and he's Medicare eligible, he should probably go ahead Okay, so if he's Medicare eligible, he should probably go ahead and apply for Medicare so he can avoid that, Medicare enrollment penalty. So yeah, that would be the answer to that question. Let me know if you have any follow-up questions on that. Okay, this is the last, sort of substantive bullet point on the checklist, but it's only one slide long, so we're almost there. Okay, and the follow-up, even if he's currently covered under your benefits. Okay, I see. I think probably if he's already Medicare eligible, I'm going to say probably, but I'm also going to say that to get the real answer, you should contact our healthcare unit. You can email them at acera.org/contact or call them at 510-628-3000 because I don't know. I'm sorry. I can't give you a definitive answer. I think probably though, but they'll give you the real answer. Yeah. Okay. So just really quickly, because these life events don't necessarily apply to everyone, I'll just touch on them really briefly. If you are going to become a deferred member, which means if you recall earlier that you stop working before you retire, you don't go straight into retirement. So you have your last day of work, and then there's some space between that and your retirement date. As a deferred member, you're still an Acera member, you're just kind of on hold, and you're just going to retire at some later date. There are some things that you should know about being a deferred member, and you should check those out on our deferred membership page at acera.org/deferred. Okay. Now, I mentioned this earlier, but we've talked about in the presentation what the death benefits are for if you die after retirement. Now, if you should die before retirement, hopefully that does not happen. But if you do, then there are death benefits available to your beneficiaries. And so you should check those out and know what those are at our death benefits page, acera.org/death. Okay, if you get divorced or you dissolve your state-registered domestic partnership, there are things that you will want to know about how that affects your Acera benefits because California is a community property state, which means that retirement benefits that you earned while you're married or while you're in a state-registered domestic partnership are community property that are on the table for division during the divorce or domestic partnership dissolution process. So go to our divorce page and please review that information there. There's what I've told you about the retirement so far, where you go through your career, you plan to retire, and then you retire based on your plan. That's what we call service retirement, or sometimes known as regular retirement. There's also times in people's careers where that doesn't work out. And for people who become permanently disabled and have to retire early, then we offer the opportunity to apply for what we call disability retirement, which is kind of a separate retirement process where you have to go through some medical examinations, and there's a whole bunch of steps to be awarded a disability retirement. But it is something that if you are permanently disabled and you can't perform your job duties, I highly suggest considering applying to retire for disability retirement and at least going through this page to see what it entails. Okay, now if you're going to work after retirement, I mentioned this earlier. If you work for anyone but our 6 participating employers, have at it. Hopefully, you don't have to work after retirement if you don't want to. And Jean's going to talk about that in just a minute. But if you do want to work after retirement, go work wherever you want. We're going to consider you a Acera retiree. We're going to pay you your retirement allowance every month for the rest of your life. Unless you try to go back to work for your employer or one of our other 5 participating employers. And then there are some restrictions and duration limits that you should be aware of. So you can check that out on this page, acera.org/working-after-retirement. And then finally, if you're going to relocate after retirement, please just submit an address change request form to us. It helps us keep track of where you're at and send you official correspondence, including the open enrollment materials we're going to send every year. So here's a page for that, acera.org/address-phone-change. Okay, last thing, sign up for Acera email news. This is how to keep track of what's going on in Acera. We don't send out hardly anything, just the important stuff. So if you don't want to constantly check our news page to see what's happening with your Acera benefit, then just go to acera.org/subscribe, and you'll get news once in a blue moon from Acera. Okay, so that is it. Oh yeah, more questions. Here's what I was talking about earlier. You can email us at acera.org/contact or call us at 510-628-3000. And on behalf of Acera's Board of Retirement and Acera staff, I wish you an amazing, beautiful retirement. Thank you for spending this time with me, and I wish you a beautiful retirement and a beautiful life.